The most dangerous financial decisions are not always the ones that look reckless. Sometimes the most dangerous decision looks responsible. It looks mature. It looks stable. It looks like a home. It looks like a key in your hand, a clean front door, a quiet street, a place you can finally call yours. And that is exactly why people stop questioning it. Because once something looks responsible, we assume it must be wise. But those are not the same thing. A decision can look responsible from the outside and still quietly reduce your freedom for years. A decision can impress your family and weaken your financial position. A decision can make you feel safe today and make your future options smaller tomorrow. And that is the uncomfortable truth behind the whole debate about owning, renting, investing, debt, property, and wealth. The real question is not, should you buy or should you rent? The real question is, what kind of freedom are you willing to trade for the feeling of permanence? Because permanence has a price. Sometimes that price is worth paying. Sometimes it is not. But if you do not know the price, you are not making a decision. You are buying a feeling, and feelings are terrible at calculating interest. Let's begin with something almost nobody wants to admit. A home is never just a financial asset. It is an emotional object. It carries status. It carries identity. It carries family expectations. It carries the memory of what people told you success was supposed to look like. It carries the fear of being left behind. It carries the quiet pressure of adulthood. It carries the sentence many people never say out loud, "I need something that proves I am not failing." That sentence is dangerous, not because wanting a home is wrong. Wanting a home is normal. Wanting stability is normal. Wanting a place that does not depend on someone else's decision is normal. Wanting roots is normal. The danger begins when you confuse emotional relief with financial clarity. Those two can feel similar in the beginning. But over time, they behave very differently. Emotional relief says, "Finally, I did it." Financial clarity says, "I can sustain this without losing the rest of my life." Emotional relief is loud on the day you sign. Financial clarity is quiet 6 years later, when the payment still fits, the maintenance is planned, your emergency fund still exists, and your life has not been reduced to protecting one decision. That is the difference. And most people do not discover the difference at the beginning. They discover it after the excitement wears off, after the congratulations stop, after the photos are old, after the first unexpected bill, after the first month when money feels tight, after the first time they want to change jobs but cannot take the risk, after the first time they realize that owning something did not automatically make them free. It simply gave them something new to protect. And protection is not free. This is where the conversation gets more serious. People love to talk about ownership as if it only means control. But ownership also means exposure. You own the upside. You also own the problems. You own the appreciation, if it happens. You also own the repairs. You own the pride. You also own the inflexibility. You own the place. You also own the consequences of being tied to it. And that does not make ownership bad. It makes ownership real. A mature person should be able to say both things at once. Owning can be powerful. Owning can also be expensive in ways that do not appear in the purchase price. Renting can be inefficient. Renting can also preserve optionality. Investing can grow wealth. Investing can also test your nervous system. Debt can accelerate progress. Debt can also trap you inside your own optimism. There is no sacred path. There are only trade-offs. And if there is one idea that should guide this whole script, it is this. The winner is not the person who owns the most visible asset. The winner is the person who has the strongest position. Position is not the same as appearance. Appearance is what people see. Position is what your life can survive. Appearance is the house, the car, the lifestyle, the public proof. Position is liquidity, low fragility, income stability, useful skills, manageable debt, diversified assets, and the ability to say no. Appearance gets applause. Position gives you choices. And choices are one of the most underestimated forms of wealth. Because wealth is not only the ability to buy, it is also the ability to wait, to move, to refuse, to survive a bad year, to take an opportunity without panicking, to avoid selling at the worst moment, to avoid taking the first offer because you are desperate, to avoid staying in a job that is slowly draining you because your monthly payment owns your courage. That is wealth too. Invisible wealth. And invisible wealth is hard to respect in a culture addicted to visible proof. That is why many people trust a house more than a portfolio. A house has weight. A portfolio has numbers. A house has walls. A portfolio has volatility. A house can be shown. A portfolio has to be understood. A house feels like something. A portfolio feels like an idea until you learn how money actually compounds. And because most people prefer what they can touch, they often underestimate what they can move. Liquidity looks weak until you need it. Flexibility looks immature until the world changes. Optionality looks abstract until the person who has it can walk away from a bad deal, while the person who does not have it has to accept whatever life offers. That is when the invisible becomes very real. So let's separate the emotional story from the financial structure. The emotional story says, buying a home means you made it. The financial structure asks, at what cost, with what risk, under what conditions, and compared to what alternative? The emotional story says, renting is throwing money away. The financial structure asks, what are you doing with the money, time, flexibility, and capital you are not locking into ownership? The emotional story says, real estate is always safe. The financial structure asks, safe compared to what? Safe for whom? Safe at what price? Safe with how much debt? The emotional story says, investing is risky. The financial structure asks, is the risk volatility, ignorance, bad behavior, concentration, poor timing, or lack of a plan? The emotional story needs villains and heroes. The financial structure needs variables. That is why people prefer the emotional story. It is easier. It gives you a side. It gives you a sentence. It gives you something to repeat at dinner. But a sentence is not a strategy. And when the decision is large enough to shape 10, 15, or 20 years of your life, you cannot let a sentence do the work of a system. This is where many people fail. They ask, what is better, buying or renting? That question is too small. A better question would be, what decision gives me the strongest life position over the next decade, considering my income, my liquidity, my risk tolerance, my mobility, my family needs, my career path, my debt, my personality, and my ability to stay disciplined? That question is longer, less viral, less satisfying, but it is much closer to reality. Because reality does not care which side sounds smarter. Reality cares whether you can sustain the decision after the emotion disappears. And emotion always disappears. The excitement of buying fades. The excitement of investing fades. The excitement of a new plan fades. Then routine begins. And routine is where the truth lives. A home is not tested on closing day. A home is tested on an ordinary month, after the payment, after the repairs, after the taxes, after the insurance, after the life expenses, after the fatigue. An investment strategy is not tested when the market is rising. It is tested when everything is falling and your brain begs you to do something stupid. Renting with a plan is not tested when you explain it to someone. It is tested when the extra money is sitting there, and you have to choose between investing it or spending it on a better lifestyle. Discipline is invisible until temptation appears. That is why this subject cannot be reduced to ownership versus renting. It is deeper than that. It is permanence versus flexibility, identity versus liquidity, control versus comfort, roots versus mobility, visible success versus invisible strength. And the painful part is that both sides offer something real. That is what makes the decision difficult. If one side were obviously stupid, this would be easy. But ownership offers real things: a shelter, predictability, a sense of place, forced savings, potential appreciation, protection from certain rental risks, a long-term asset, a base for family life, a psychological anchor. Those are not imaginary, they matter. But flexibility also offers real things: mobility, liquidity, lower concentration, the ability to invest elsewhere, the ability to change cities, the ability to change jobs, the ability to avoid being house rich and cash poor, the ability to adapt when your life changes. Those also matter. The problem begins when a person wants all the benefits of both paths without paying the cost of either. They want the emotional stability of owning and the flexibility of renting. They want the upside of leverage and the safety of no debt. They want the growth of investing and the comfort of never seeing volatility. They want the social approval of ownership and the freedom of liquidity. They want roots and wings at the same time. And life sometimes gives you both. But usually not at the beginning. Usually you must choose which cost you can live with. That is the adult question. Which cost can you live with? Not which path sounds better. Not which path impresses people. Not which path your parents understand. Not which path a creator online turned into a confident rule. Which cost fits your life? Because every path has a cost. Buying has a cost. Renting has a cost. Investing has a cost. Waiting has a cost. Acting too early has a cost. Acting too late has a cost. The mistake is not paying a cost. The mistake is pretending one path has none. That is how people get trapped. They buy and pretend maintenance does not exist. They rent and pretend discipline will happen automatically. They invest and pretend volatility will not hurt. They take debt and pretend future income is guaranteed. They wait and pretend time is neutral. Time is not neutral. Debt is not neutral. Rent is not neutral. Cash is not neutral. A house is not neutral. Every choice pushes your life in a direction. And if you do not choose consciously, your defaults choose for you. Your fear chooses. Your family chooses. Your culture chooses. Your desire for approval chooses. Your impatience chooses. Your avoidance chooses. And then one day you wake up inside a life that feels accidental, even though every piece of it came from decisions you made. That is why clarity matters. Clarity is not glamorous, but it is protective. Clarity says, I know what I am buying. I know what I am giving up. I know why this matters to me. I know what could go wrong. I know what I will do if it does. I know this is not about proving something to people who will not pay the bill. That last line matters, because many people are not making housing decisions. They are making reputation decisions. They are trying to answer a social question with a financial contract. The social question is, are you successful yet? And instead of rejecting the question, they try to buy an answer. But you cannot buy a healthy identity with an unhealthy loan. You cannot repair insecurity with a mortgage. You cannot prove adulthood by accepting a payment that makes you financially fragile. You cannot turn fear into wisdom just because the fear signed official papers. A legal document does not make a decision wise. It makes it enforceable. And that is a very different thing. So before we go deeper, let's define the real enemy. The enemy is not home ownership. The enemy is not renting. The enemy is not investing. The enemy is not debt. The enemy is unconscious commitment. A commitment made before you understand its full cost. A commitment made to calm anxiety. A commitment made because everyone else seems ahead. A commitment made because the market feels like it is running away. A commitment made because you confuse movement with progress. A commitment made because you would rather be stressed inside something that looks successful than patient inside a plan that nobody can see. That is the enemy. And it is powerful because it wears the mask of responsibility. It does not feel reckless. It feels urgent. It feels mature. It feels like catching up. But catching up to what? A cultural timeline? A family expectation? A version of adulthood that may not fit the current economy? A dream you inherited but never examined? This is where the ownership debate becomes personal, because it is not only about money. It is about the story you believe your life is supposed to follow. There is an old story. Work hard, save money, buy a home.
Settle down.
Build equity, become secure. That story is not worthless. It helped many people. It created stability for many families. It gave people a tangible way to build wealth. It turned discipline into structure. But a story can be useful in one era and incomplete in another. A map can be accurate for one landscape and misleading in a different one. And today, many people are using maps they inherited from a different financial landscape. Different incomes, different housing prices, different credit conditions, different job stability, different family structures, different mobility, different expectations, different lives. The principle may still be valid. Build stability. Do not waste everything. Own assets. Think long-term. Prepare for the future. Those principles are still strong, but the vehicle may need to change, or at least the timing, or the size, or the order. Maybe the old advice was not wrong. Maybe it was incomplete. Maybe the goal was never buy a home as soon as possible. Maybe the deeper goal was build a life that is not constantly at the mercy of someone else. And if that is the deeper goal, then a home is one possible tool. Not the only tool, not always the first tool, not always the right tool at the wrong time. The purpose is security. The tool is negotiable. That sentence alone can free a lot of people. The purpose is security. The tool is negotiable. A home can create security. A portfolio can create security. Cash reserves can create security. Skills can create security. A business can create security. Insurance can create security. Low expenses can create security. Strong relationships can create security. Geographic flexibility can create security. The strongest people often do not rely on one layer. They build multiple layers, because one layer can fail. A house can fail as a strategy if the payment is too heavy. A job can fail. A market can fall. A tenant can stop paying. A business can struggle. A city can become unaffordable. A relationship can change. Your own priorities can change. Security is not one wall. It is a structure. And structures need more than one support. That is why someone can own a home and still be financially fragile. And someone can rent and still be financially strong. People hate that sentence because it breaks the simple ranking system. But it is true. Owning does not automatically mean strong. Renting does not automatically mean weak. Investing does not automatically mean smart. Debt does not automatically mean reckless. Cash does not automatically mean lazy. The category is not enough. The structure behind the category matters. A homeowner with no emergency fund, high debt, unstable income, and no flexibility may be far more fragile than a renter with diversified investments, low expenses, strong savings, and the ability to move for better opportunities. At the same time, a renter with no savings, no plan, no discipline, and a lifestyle that consumes every dollar may be far weaker than a homeowner who bought conservatively and keeps building wealth. The label does not decide, the structure decides. That is the central lesson. And it is harder than choosing a side, because sides are emotionally satisfying. Structure is demanding. Structure forces you to look at your numbers, your habits, your risk, your psychology, your timeline, your actual life, not the life you perform, the life you must pay for. Let's talk about that phrase. The life you must pay for. Most people do not calculate life as a system. They calculate purchases, a payment here, a subscription there, a loan here, a rent there, a future plan somewhere. But your life does not experience those things separately. Your life experiences the total load, the total weight, the total stress, the total loss of options. A home payment that looks manageable alone may not be manageable inside your real life. An investment plan that looks smart on paper may not survive your emotional behavior. A rental situation that looks flexible may become wasteful if you never build assets. A debt that looks efficient may become dangerous if it removes your ability to adapt. The total system matters, and housing is usually one of the biggest forces inside that system. It can stabilize the system, or it can dominate it. When a home dominates your system, everything else becomes secondary. Your job choices become about the payment. Your savings become about the property. Your stress becomes tied to repairs. Your mobility becomes limited. Your investment capacity shrinks. Your tolerance for risk drops. Your life becomes organized around preserving the asset. Again, that might be acceptable if you chose it consciously. If you wanted roots more than flexibility. If the payment is reasonable. If the home fits your long-term life. If the trade-off is worth it. But if you did not choose consciously, the home begins to choose for you. And that is when ownership becomes less like freedom and more like management. Management of debt, management of repairs, management of location, management of fear, management of expectations, management of your own regret if you suspect you moved too fast. That is not the dream people advertise, but it is part of the reality. A mature conversation must include both. The dream and the maintenance, the pride and the pressure, the appreciation and the illiquidity, the stability and the lost optionality, the ownership and the obligation. If a conversation includes only the dream, it is marketing. If it includes only the fear, it is cynicism. We need neither. We need clarity. So here is a better way to think. Do not ask whether owning is better than renting. Ask what each one does to your future choices. Owning may reduce some choices and increase others. It may reduce mobility, but increase housing stability. It may reduce liquidity, but build equity. It may reduce your ability to take short-term risks, but increase your feeling of permanence. It may reduce your diversification, but give you a base. Renting may reduce permanence, but increase mobility. It may feel like money leaves every month, but preserve capital for other uses. It may expose you to rent increases, but protect you from repair surprises. It may give flexibility, but require discipline, because nobody forces you to build equity. Investing may increase long-term wealth potential, but expose you to volatility. It may be liquid, but that liquidity can become dangerous if you panic. It may diversify, but feel emotionally abstract. Each path gives, each path takes. The question is not which path is morally superior. The question is, which trade-off makes your life stronger? That is the adult frame. And once you adopt that frame, a lot of popular advice starts sounding incomplete. Buy as soon as you can. Incomplete. Never buy, just invest. Incomplete. Renting is throwing money away. Incomplete. Real estate always wins. Incomplete. Stocks always outperform. Incomplete. Debt is bad. Incomplete. Debt is how rich people get richer. Incomplete. Each sentence may be true in one context and dangerous in another. And the problem with financial content is that certainty spreads faster than nuance. A confident rule is easier to share than a careful framework, but careful frameworks protect people better. The goal of this script is not to give you a slogan. It is to make you harder to manipulate by sellers, by banks, by influencers, by family pressure, by your own fear. Because the person who does not understand trade-offs is easy to pressure. Tell them prices will rise forever, and they panic. Tell them rent is wasted money, and they feel shame. Tell them investing is the only intelligent path, and they ignore emotional risk. Tell them ownership is the only proof of maturity, and they overextend. Tell them flexibility is freedom, and they avoid commitment forever. Every simple narrative can trap a different type of person. The anxious person overbuys. The avoidant person never commits. The impatient person chases returns. The status-driven person buys too much house. The fearful investor stays in cash forever. The undisciplined renter spends the difference. The overconfident buyer ignores downside. The overeducated procrastinator analyzes for 10 years and never acts. Everyone has a trap. The key is knowing yours, because your best strategy is not just the one with the best spreadsheet. It is the one you can actually live without self-sabotage. That matters. If you cannot handle volatility, a theoretically optimal investment plan may fail in your hands. If you cannot handle debt, a theoretically good mortgage may damage your peace. If you cannot save voluntarily, renting and investing the difference may become a fantasy. If you cannot tolerate feeling behind, you may buy before you are ready. If you cannot commit to a place, ownership may feel like a cage. If you cannot say no to lifestyle inflation, higher income may not save you. This is why finance is never only math. It is math under human behavior. And human behavior is messy. People do not just optimize, they fear. They compare. They justify. They deny. They chase. They freeze. They perform. They protect their ego. They rewrite the past. They pretend decisions were rational after making them emotionally. That is normal, but it is expensive. So the first step is not choosing a house or a portfolio. The first step is becoming honest enough to see the emotional force behind the decision. Ask yourself, do I want to own because the numbers work, or because I am tired of feeling temporary? Do I want to rent because flexibility matters, or because I am afraid of responsibility? Do I want to invest because I understand long-term compounding, or because I want to feel smarter than people who buy property? Do I want to wait because the timing is wrong? Or because making a decision terrifies me? Those questions are uncomfortable because they remove the costume. And a lot of financial decisions wear costumes. Fear dresses like caution. Impulse dresses like courage. Status dresses like stability. Avoidance dresses like patience. Speculation dresses like investing. Overspending dresses like self-care. Debt dresses like ambition. A costume can fool other people, but it cannot protect your future. Only structure can. That is why this script will keep returning to one idea. Position over proof. A strong position gives you proof eventually, but proof without position can collapse. A person with strong position may not look impressive for a while. They may rent. They may drive an ordinary car. They may avoid lifestyle inflation. They may invest quietly. They may wait longer than others. They may buy less house than the bank allows. They may disappoint people who expected a more visible life, but inside the system, they are getting stronger. Less fragile, more liquid, more capable, more patient. And patience becomes a weapon when everyone else is desperate. Because desperation makes people overpay. Desperation makes people accept bad terms. Desperation makes people buy what they do not understand. Desperation makes people stay in places they should leave. Desperation makes people sell assets at the wrong time. Desperation makes people confuse any available option with a good option. The person with margin can wait, and waiting is not passive when it is strategic. Waiting with cash, knowledge, discipline, and a clear target is different from waiting with excuses. One is preparation, the other is avoidance. Again, the label is not enough. The structure matters. So when someone says, I am waiting to buy, the question is, what are you building while you wait? If the answer is nothing, then waiting may be decay. If the answer is liquidity, income, skills, investment capital, market understanding, and emotional clarity, then waiting may be strategy. When someone says, I am buying, the question is, what remains after you buy? If the answer is no emergency fund, no investment capacity, no margin, and no flexibility, then buying may be fragility. If the answer is stable payment, reserves, long-term fit, and a clear purpose, then buying may be strength. When someone says, I am investing instead, The question is, can you stay invested when the numbers fall? If the answer is no, then investing may be theater. If the answer is yes, because the plan is diversified, long-term, and sized correctly, then investing may be power. This is how adult finance works, not by category, by behavior and structure. Now, let's go deeper into the psychology of permanence. Why does ownership feel so powerful? Because permanence answers a primitive human need. A place, a base, a boundary between you and the world, a door you can close, a room that remembers you, a space that does not feel borrowed. That matters. In a world where jobs change, relationships change, cities change, platforms change, and prices change, a physical place can feel like proof that something is stable. This is why people do not talk about homes the way they talk about other purchases. A home is not just square footage. It is emotional geography. It says, I belong somewhere. I have a base. I'm not floating. I built something. That need is real. Do not let anyone mock it. There is a cold type of financial advice that treats every emotional need as irrational. That advice is incomplete. Humans are not spreadsheets. A life with perfect liquidity and no sense of home may not feel successful. A mathematically efficient strategy can still fail if it leaves the person emotionally ungrounded. So yes, home can matter beyond return. But there is another danger. Because the need is so deep, people can overpay for emotional geography. They can accept financial fragility in exchange for a feeling of belonging. They can buy permanence before they have built resilience. They can mistake the emotional power of a place for the financial quality of the deal. That is where the danger lives. Not in wanting home, in letting the feeling of home override the cost of home. There is a line between paying for quality of life and sacrificing your entire financial future to look stable. That line is not the same for everyone, but it exists. And you need to find it before you sign, not after. Because after you sign, your brain becomes less honest. Once you commit, you start defending the commitment. You look for reasons why it was right. You minimize problems. You compare yourself to people who made worse decisions. You say things like, at least it is mine. At least I am not renting. At least it will probably go up. At least I'm building something. Maybe all of that is true. But at least can become a dangerous phrase. Sometimes, at least is gratitude. Sometimes it is denial. You have to know the difference. Denial sounds like comfort, but it blocks correction. And correction is one of the most important financial skills. Not perfection. Correction. You will make imperfect decisions. Everyone does. But if your identity depends on proving every decision was wise, you will keep bad strategies alive too long. That is how people lose years. Not because they made one mistake, because they turned the mistake into identity. They could not say, I miscalculated. I bought too much. I should have waited. I should have invested earlier. I was afraid. I wanted approval. I did not understand the full cost. That kind of honesty hurts, but it gives you your hands back. As long as you are defending the old story, you cannot build a better one. So let's make something clear. Changing your mind is not failure. Refining your plan is not failure. Selling a property that does not fit anymore is not automatically failure. Continuing to rent while building capital is not failure. Buying smaller than expected is not failure. Admitting you are not ready is not failure. Failure is letting pride keep you trapped in a decision you no longer believe in. That is failure. And many people do it because public proof becomes emotional prison. They announced the decision. They celebrated it. People congratulated them. Now they feel they must protect the image. But your future should not be sacrificed to protect an old announcement. You are allowed to update. You are allowed to learn. You are allowed to make the next decision from better information. That is how wealth is built in real life, not through perfect ideology, through better adjustments. Now let's talk about the opposite side, the danger of worshiping flexibility. Because some people hear everything we have said so far and think, good, then owning is a trap. No, that is too easy. Flexibility can be power. It can also become avoidance. There are people who call themselves flexible because they do not want responsibility. They say they value options, but they never choose anything. They say they are waiting for the right moment, but they are really hiding from commitment. They say they prefer liquidity, but they spend every surplus. They say they are investing in themselves, but they are mostly consuming comfort. They say ownership is outdated, but they have no alternative system. That is not freedom. That is drift, and drift can look sophisticated for a while, especially in a culture that praises optionality. but optionality without direction becomes emptiness. Freedom is not just the absence of commitment. Freedom is the ability to commit wisely. A person who can move but has no plan is not free in the deepest sense. They are simply unanchored. A person who rents but does not invest is not automatically flexible. They may just be postponing. A person who avoids debt but never builds assets is not automatically prudent. They may just be afraid. A person who criticizes home ownership but has no savings, no investments, and no plan is not enlightened. They are exposed. So the point is not to glorify flexibility. The point is to use flexibility as a tool. Flexibility should buy you time to build, not time to drift. It should help you improve your income. Build reserves, invest consistently, study markets, avoid bad deals, move toward better opportunities, design a life that can handle change. If flexibility does not become strength, it becomes delay. And delay has a cost, a quiet cost, a cost that does not always appear month by month, but appears over years. Years without assets, years without discipline, years without compounding, years without a clear direction. Years of telling yourself you are not tied down, when in reality you have not built anything strong enough to tie yourself to. That is why the debate must be honest on both sides. Ownership can become a cage. Flexibility can become drift. Investing can become power. Investing can also become panic and performance. Renting can be strategy. Renting can also be consumption with better branding. Debt can be a tool. Debt can also be a leash. Cash can be safety. Cash can also be stagnation. The same tool changes, meaning depending on the person using it. That is why your financial personality matters. Not in a mystical way. In a practical way. Some people need structure. Some need flexibility. Some need automatic systems. Some need liquidity because their work is unstable. Some need a home because their life genuinely requires roots. Some need to avoid a large mortgage because they become anxious under debt. Some need to stop waiting because their fear is disguised as analysis. Some need to stop rushing because their ambition is really insecurity. The right strategy is not only mathematically sound, it must be psychologically sustainable. Because a strategy you cannot live is not your strategy. It is a fantasy wearing good numbers. This is especially true with long-term investing. On paper, investing can look beautifully simple. Put money in, diversify, keep contributing. Wait, let compounding work. Do not panic. Do not chase. Do not try to predict every movement. Simple. But simple is not easy, because markets do not test your intelligence first. They test your emotions. They test your patience. They test your ego. They test your ability to watch temporary loss without turning it into permanent loss. They test whether you actually believed your plan or only liked it when the line went up. That is why a person can understand investing and still fail at investing. Understanding is not the same as behavior. The same is true with real estate. A person can understand that ownership builds equity and still buy a terrible property. A person can understand rent versus price and still ignore maintenance. A person can understand leverage and still take too much of it. A person can understand appreciation and still forget liquidity. Knowledge is necessary, but behavior decides the outcome. So the real skill is integration. Numbers plus behavior, ambition plus defense, stability plus optionality, emotion plus honesty. That is the skill we are building here. Not a rule, a way of seeing. And once you see this way, simplistic advice starts losing power over you. Someone says, "You need to own." You ask, "At what cost to my options?" Someone says, "Just rent and invest." You ask, "Will I actually invest the difference?" Someone says, "Real estate is safe." You ask, "Safe under which scenario?" Someone says, "Markets return more." You ask, "Can I handle the path, not just the average?" Someone says, "Debt is how you get rich." You ask, "What happens if the asset disappoints?" Someone says, "Cash is trash." You ask, "How much liquidity do I need to avoid becoming desperate?" This is financial maturity, not having the loudest opinion, having the better questions. The better questions protect you. They slow down fear. They expose hidden costs. They separate identity from strategy. They help you resist pressure. They make you less available to manipulation. And in a world where everyone is selling you certainty, better questions are a form of defense. Now we need to explore one of the biggest hidden forces behind all of this: the cost of being unable to change. People talk about the price of a home. They talk about the down payment. They talk about the monthly payment. They talk about interest. They talk about appreciation. They talk about rent, but they rarely talk about the cost of being unable to change. What is it worth to be able to move for a better job? What is it worth to leave a toxic workplace? What is it worth to start a business without a massive fixed payment? What is it worth to survive a year of uncertainty without panic? What is it worth to take advantage of an investment opportunity because your capital is not completely locked? What is it worth to wait for a better deal? What is it worth to say no? These things are hard to measure, so people ignore them. But hard to measure does not mean worthless. In fact, some of the most valuable things in life are hard to measure. Peace, mobility, time, resilience, negotiating power, the ability to wait, the ability to leave, the ability to choose. A house is easy to see. Optionality is not. That is why optionality is so often underpriced in personal decisions. People willingly give it away because nobody congratulates them for keeping it. Nobody says, "Congratulations on preserving your strategic flexibility." Nobody throws a party because you avoided overcommitting. Nobody posts a photo of your emergency fund. Nobody praises the opportunity you did not lose because you had liquidity. But those invisible wins matter a lot. Many lives are not changed by the big visible victory. They are changed by the disaster that never happened because someone had margin. The bad loan they did not take, the property they did not overbuy, the panic sale they avoided, the job they could leave, the medical emergency they could handle, the investment opportunity they could take, the move they could make, the pressure they could resist. That is wealth. It does not always look like wealth, but it behaves like wealth, and behavior matters more than appearance. Now, let's pause here. If you are listening to this while working, driving, walking, or lying in bed, you may feel that this topic is not really about housing anymore. Good, because it never was only about housing. Housing is the doorway. The deeper subject is control. Who controls your future choices? Your fear, your debt, your need for approval, your lack of discipline, your desire for comfort, your old family script, or you? That is the real question. And every housing decision answers it in some way. When you buy too much house because you need to feel successful, fear and status control the decision. When you rent with no plan because commitment scares you, avoidance controls the decision. When you invest without understanding because you want to feel sophisticated, ego controls the decision. When you stay in cash forever because volatility terrifies you, fear controls the decision. When you choose a smaller home, keep liquidity, and continue investing, structure controls the decision. When you rent intentionally, invest consistently, and build optionality, strategy controls the decision. When you buy for stability, because it fits your life and you can sustain it, clarity controls the decision. The goal is not one path. The goal is that clarity controls the decision. That is the whole point. And in the next part, we need to go deeper into the silent mathematics of permanence. Not just the payment, not just the price, but the hidden equation behind every major financial commitment. What you gain, what you lose, what you cannot do anymore, and what version of yourself will have to live with the trade. The silent mathematics of permanence begins with one idea. Every major financial commitment buys something and closes something. It opens one door. It closes others. That does not mean the decision is bad. It means the decision is real. A home can open the door to stability, but it can close the door to mobility. It can open the door to equity, but close the door to liquidity. It can open the door to pride, but close the door to certain risks you might have taken. It can open the door to roots, but close the door to easy reinvention. And the same is true for not buying. Renting can open the door to flexibility, but it can close the door to forced equity. It can open the door to mobility, but it can close the door to long-term housing control. It can open the door to investing elsewhere, but it can close the door to the emotional security of permanence. Investing can open the door to compounding, but it can close the door to emotional comfort if volatility controls you. Keeping cash can open the door to safety, but it can close the door to growth if fear keeps it idle forever. There is always a door that closes. And adult decision-making begins when you stop pretending otherwise. Most people only look at the door that opens. They imagine the new home, the new status, the new stability, the future appreciation, the feeling of having finally arrived. Or they imagine the portfolio, the freedom, the liquidity, the compounding, the intellectual satisfaction of making a cleaner financial choice. But they do not stare long enough at the door that closes. The job they may not be able to leave. The city they may not be able to exit. The business they may not start, the cash they may not have, the volatility they may not tolerate, the lifestyle they may not be able to maintain, the years they may spend defending a decision instead of expanding their life. And that is where the hidden cost lives, not in what the decision gives you, in what it quietly removes. This is why opportunity cost matters so much. Opportunity cost is not just an economic concept. It is the ghost of the life you did not choose. It is the investment you could not make because the down payment was gone. It is the emergency fund you did not have because the house needed furniture, repairs, fees, and adjustments. It is the better job you could not take because moving became complicated. It is the business you never tried because the monthly obligation made risk feel impossible. It is the ability to wait for a better deal, lost because you needed something now. It is the mental space consumed by one decision. Opportunity cost does not send you an invoice. That is why people ignore it. But the absence of an invoice does not mean there was no payment. You paid. You paid with alternatives. You paid with flexibility. You paid with time. You paid with psychological space. You paid with paths that became harder. Sometimes the trade is worth it. Sometimes the life you get is better than the life you leave behind. But you should know what you are leaving behind. Because uncounted costs are still costs. And in housing, uncounted costs can be enormous. The visible cost is the purchase price. The visible cost is the monthly payment. The visible cost is the initial cash required. But the invisible cost is the reorganization of your life around one heavy object. A home is financially heavy, emotionally heavy, geographically heavy, administratively heavy. It has gravity. And once you place that gravity in the center of your life, other things begin to orbit around it. Your career decisions, your savings rate, your stress, your risk tolerance, your spending, your relationships, your ability to move, your ability to invest, your ability to say yes, your ability to say no. This is not automatically bad. Gravity can create order. A home can anchor a life. A home can give structure. A home can provide a center. But gravity can also pull too hard. It can make every other part of your life smaller. The difference is not the home itself. The difference is proportion. How much of your life does this decision consume? How much income? How much savings? How much attention? How much emotional energy? How much future flexibility? How much risk capacity? If the answer is almost everything, then you are not buying a home. You are reorganizing your entire life around a single bet. Maybe that bet works, but call it what it is. A bet. People dislike that word when it is attached to housing. But they prefer words like stability, investment, responsibility, maturity, and those words may be valid. But any large commitment under uncertainty contains a bet on your income, a bet on the property, a bet on the neighborhood, a bet on interest conditions, a bet on your future needs, a bet on your ability to stay, a bet on the market, a bet on your personal life not changing too violently. The problem is not betting. The problem is believing you are not betting because the object is made of concrete. Concrete does not eliminate uncertainty. It only makes the uncertainty feel heavier. So let's ask the first serious question. If the home does not appreciate quickly, does the decision still make sense? Many people cannot answer that. They assume appreciation will rescue the decision. They assume time will forgive overpayment. They assume the future buyer will validate their present choice. But if the entire decision depends on someone else paying more later, then you need to be honest. You are not just buying shelter. You are speculating. That may be acceptable. Speculation is not automatically evil. But disguised speculation is dangerous. A person who knows they are speculating can size the risk. A person who thinks they are being conservative may overcommit. This happens often with housing, because property feels conservative. It feels respectable. It feels grounded. But a respectable object can still be purchased at a foolish price. A grounded asset can still be financed dangerously. A real building can still produce unreal expectations. The second serious question is, if your income weakens, does the decision survive? Not if your income collapses forever. That is an extreme case. But if your income drops for several months, if a bonus disappears, if a client leaves, if a job changes, if someone in your family needs help, if you need medical care, if your working rhythm changes, does the decision survive? Or does it immediately become a crisis? A strong decision can absorb some imperfection. A fragile decision requires life to behave perfectly, and life rarely behaves perfectly for long. This is why resilience matters more than optimism. Optimism helps you act. Resilience helps you survive after acting. You need both. Optimism without resilience is how people walk confidently into traps. Resilience without optimism is how people never move. The mature posture is, I believe in the future, but I respect what can go wrong. That sentence should guide every major financial commitment. Believe, but leave margin. Act, but protect downside. Buy, but do not erase liquidity. Invest, but know your time horizon. Rent, but build something with the flexibility. Wait, but do not decay. The third serious question is, what does this decision do to your ability to change? This may be the most underestimated question, because change is not an exception anymore. Change is part of modern life. Careers change, industries change, cities change, relationships change, technology changes, health changes, ambitions change. Your own sense of identity changes. A decision that assumes your life will remain stable for decades needs to be treated carefully. Maybe your life is stable. Maybe you genuinely want roots. Maybe your profession, family, and values align with permanence. Good. Then ownership may fit. But if your life is still moving, if your work may take you elsewhere, if your income is evolving, if your relationships are not settled, if your ambitions are still forming, if you are still discovering what kind of life you want, then a very rigid financial decision can become a conflict. Not immediately, but gradually. At first, it feels like achievement. Later, it may feel like friction. Your life wants to move, but the asset wants you to stay. Your career wants optionality, but the payment wants predictability. Your ambition wants risk, but your debt wants obedience. Your identity wants exploration, but your home wants continuity. That tension can be healthy if you chose it knowingly. It can be suffocating if you did not. This is why the decision to own is also a decision about your biography. Not just your finances. You are not simply asking, can I buy this? You are asking, does this version of stability fit the life I am actually building? That question is deeper. It prevents you from buying someone else's definition of adulthood. Because that is what many people do. They do not buy a home. They buy a timeline. They buy the feeling that their life is finally in the correct order. They buy relief from the anxiety of being undefined. But a home cannot define you in a healthy way. It can support a life. It should not be used to replace one. If you do not know what you want, a mortgage will not give you identity. It will only give you a payment while you keep searching. And searching under financial pressure is much harder. Now, let's talk about the phrase that has probably shaped more bad decisions than people realize. At least I am building equity. This phrase can be true. It can also be incomplete. Equity is valuable, but equity is not the only kind of strength. Equity inside a property is not the same as cash. It is not the same as diversification. It is not the same as freedom. It is not the same as low stress. It is not the same as being able to act quickly. Equity can make you wealthier on paper while leaving you tight in real life. That is the classic condition people describe as being house rich and cash poor. The net worth looks respectable. The daily life feels constrained. The asset grows. The person shrinks. Again, not always, but sometimes. And when it happens, people struggle to admit it because the balance sheet seems to say they are doing well. But your balance sheet is not the only measure. Your life has a cash flow. Your nervous system has a limit. Your future has optionality. Your time has value. Your peace has value. Your ability to take risk has value. A financial decision that improves one metric while damaging several others should not be celebrated automatically. It should be examined. A mature person asks, what kind of wealth am I building? Visible wealth, net worth, cash flow, liquidity, resilience, freedom, peace, status. Different types of wealth behave differently. Visible wealth impresses people. Liquid wealth protects you. Productive wealth pays you. Human capital increases your earning power. Social capital helps you access opportunities. Emotional wealth gives you the ability to make decisions without panic. A home may contribute to some of these, but not all. A portfolio may contribute to some, but not all. Cash may contribute to some, but not all. The strongest people usually combine forms of wealth. They do not demand that one asset do every job, because when one asset has to do every job, it often fails at several. A home should not be your emergency fund. A home should not be your entire retirement plan unless you understand what that means. A home should not be your only investment thesis. A home should not be your proof of worth. A home should not be your emotional medication. A home can be a home. It can be part of a strategy, but it cannot carry the weight of your entire financial identity. That weight is too much. Now let's examine the renting side with the same honesty. Renting is not automatically intelligent. A lot of people defend renting because it gives flexibility. But flexibility only matters if you use it. If renting gives you lower fixed costs and you invest the difference, that can be powerful. If renting allows you to move for better income, that can be powerful. If renting prevents you from overcommitting before your life is ready, that can be powerful. If renting gives you time to build a stronger down payment, understand the market, and avoid panic, that can be powerful. But if renting simply funds a lifestyle you cannot sustain, then it is not strategy. It is delay. And delay can feel comfortable while it quietly damages your future. This is why the phrase, rent and invest the difference, is incomplete. The key word is not rent. The key word is invest. If the difference is not invested, the strategy collapses. Then renting may become consumption. Again, not because renting is bad, because the system behind it is weak. Renting with a system can build wealth. Renting without a system can produce years of motion without accumulation. A person can spend a decade feeling free and later realize they were not free. They were uncommitted. Those are not the same thing. Freedom has direction. Drift only has movement. That distinction matters, because modern culture often confuses lack of roots with freedom. But a life with no roots and no assets is not necessarily free. It may simply be exposed. A person who owns nothing, saves little, invests inconsistently, and avoids commitments may feel flexible, but when a crisis appears, that flexibility may not protect them. The ability to move is valuable, but the ability to move with resources is much more valuable. Mobility without capital is fragility with motion. That is the danger. So if you rent with intention. Know why. Know for how long. Know what you are building. Know where the surplus goes. Know what would trigger a change. Know what buying conditions would make sense later. Know whether you are renting because it fits your strategy or because it helps you avoid growing up. That last line may sting. Good. It should. Because some people overbuy to feel adult. Others avoid buying to avoid adulthood. Both are emotional decisions. They just wear different clothes. One wears responsibility. The other wears freedom. Neither is automatically mature. Maturity is not owning. Maturity is not renting. Maturity is alignment. Your action aligns with your stage, your goals, your resources, your psychology, and your future direction. That is maturity. Now let's bring investing back into this. Investing is often presented as the rational alternative, and in many cases, it can be. Diversified investing can offer liquidity, participation in broad economic growth, scalability, and lower management burden than physical property. You do not have to repair a market index. You do not have to screen a tenant inside an exchange-traded fund. You do not have to repaint a diversified portfolio. You do not receive a midnight call from a stock asking you to fix the plumbing. That simplicity matters. But financial assets have their own psychological traps. They are liquid, and that liquidity can become a curse, because if you can sell in seconds, you may sell in fear. A property is illiquid, which can be inconvenient, but that illiquidity sometimes forces patience. A portfolio is liquid, which is convenient, but that liquidity sometimes enables self-sabotage. So again, the feature can become a flaw depending on the person. Liquidity is power in disciplined hands. Liquidity is danger in panicked hands. Leverage is power in disciplined hands. Leverage is danger in overconfident hands. Illiquidity can protect impatient people from themselves. Illiquidity can trap people who need to change. Nothing is pure. Everything depends on behavior. This is why the best strategy for one person may be terrible for another. A person with emotional discipline, steady income, and long-term thinking may benefit enormously from investing while renting. A person who spends every available dollar may need the forced structure of ownership, even if it is not mathematically perfect. A person with unstable income may need liquidity more than equity. A person with deep roots and predictable life needs may value ownership more than flexibility. A person building a business may need cash and mobility. A person seeking family stability may accept lower financial efficiency for emotional and practical reasons. There is no universal answer, because there is no universal life. The refusal to accept that is what creates bad advice. Bad advice takes one person's winning formula and turns it into a law for everyone. I made money in real estate, so everyone should buy. I built wealth investing, so everyone should rent. I regretted buying, so ownership is a trap. I regretted renting, so rent is waste. I hate debt, so all debt is bad. I used debt well, so leverage is always smart. Personal experience is useful, but personal experience is not universal law. Your job is to extract principles, not copy outcomes. That is an important distinction. A principle might be, do not overextend, build assets, keep margin, understand risk, avoid emotional decisions. Diversify when possible. Use debt carefully. Match strategy to time horizon. Know your behavior. Those principles travel well. Specific formulas do not. Because formulas depend on timing, market, income, personality, family support, taxes, interest rates, opportunity, and luck. People understate luck because luck makes advice less marketable. It feels better to say, I was smart, than I was smart and the timing helped me. But many housing stories contain timing. Buying before a boom, borrowing when rates were lower, entering before a neighborhood changed, receiving family support, having stable employment during a favorable period, benefiting from inflation after taking fixed debt. Those things matter. And if someone benefited from them, good. But copying their decision later, under different conditions, may not produce the same result. This is another reason you need a framework instead of a story. Stories inspire. Frameworks protect. Now let's talk about the role of income. People often say, if housing is hard, just earn more. That is not wrong. Increasing income is one of the most powerful moves, but it is incomplete. More income without better structure can disappear. People adapt quickly. A higher income becomes a higher apartment, a better car, more eating out, more subscriptions, better vacations, more comfort, more obligations, and suddenly the person feels just as tight as before. The cage got bigger, the bars got nicer. But the person is still trapped. Income matters only if it becomes position. If higher income turns into savings, investments, reserves, skill growth, and lower fragility, then it changes your life. If higher income only upgrades your fixed costs, it changes your appearance. Again, position over appearance. This matters deeply with housing because lenders often focus on what you can technically pay, but your life should focus on what you can comfortably sustain. Those are different standards. The lender asks, can this person make the payment? You should ask, can I make this payment and still live, save, invest, rest, adapt, and survive imperfection? The lender protects the lender. You protect your life. Do not confuse approval with wisdom. Approval means you qualify. It does not mean you should proceed. That line should be written above every major loan application. You can qualify for something that weakens you. You can be approved for a payment that makes your life smaller. You can be told yes by a system that does not care whether your future feels trapped. So your internal standard must be higher than external approval. Not because institutions are evil, because their incentives are not the same as yours. The seller wants to sell, the lender wants to lend, the agent wants the transaction, the platform wants engagement. The culture wants visible adulthood. Your fear wants relief. Your ego wants proof. But your future needs protection. And your future cannot speak loudly in the moment. It speaks through discomfort, through doubt, through the quiet sense that a decision might be too heavy. Do not ignore that voice. Do not obey it blindly either. Examine it. Sometimes discomfort is fear of growth. Sometimes discomfort is wisdom noticing danger. You need to distinguish them. Fear of growth says, this is new, so I want to run. Wisdom noticing danger says, the numbers do not work, and I am trying to force them. Very different. One should be challenged. The other should be respected. How do you tell the difference? By slowing down. By writing the numbers. By testing scenarios. By asking what happens if things go wrong. By removing social pressure from the decision. By asking whether the desire remains when nobody is watching. That last test is powerful. If nobody could see your home, would you still want it? If nobody admired your investment knowledge, would you still follow the plan? If nobody judged your renting, would you feel differently? If nobody called ownership success, would the deal still be attractive? These questions strip the decision down. They remove performance, and performance is expensive. Many people do not overspend for comfort. They overspend for identity. They buy the version of themselves they want others to believe. Successful, stable, adult, sophisticated, safe, ambitious, not behind, not lost, not temporary. But identity purchased externally needs constant maintenance. You must keep paying for the story. And that becomes exhausting. A healthier identity says, I do not need this decision to prove my worth. I need it to fit my life. That sentence changes everything. It lowers emotional pressure. It makes analysis possible. It lets you choose a smaller home without shame. Rent longer without feeling inferior. Invest quietly without needing applause. Wait without feeling passive. Buy when it actually fits. Sell when it no longer does. Adjust without feeling like you failed. That is freedom, not the freedom of having no commitments. the freedom of not being emotionally controlled by them. Now, we need to talk about family scripts. Many people do not make housing decisions alone. Even when they think they do, they carry voices, parents, grandparents, friends, partners, co-workers, older relatives, people who say things like, "You need something of your own. Do not make someone else rich. Property never fails. You are getting older. Renting is for people who have not planned. You will regret waiting." Some of those voices come from love. Some come from fear. Some come from experience. Some come from outdated information. Some come from social habit. You do not need to disrespect them, but you cannot let them replace analysis. Respect the intention. Test the advice. That is the mature posture, because advice born in one economic environment may not transfer cleanly to another. A person who bought under different prices, different credit conditions, different job security, different family structure, and different life expectations may be giving you advice from a world that no longer exists in the same way. They may not be wrong in principle, but the application may need translation. The principle might be, build security. The old application was, buy property as soon as possible. The modern application might be, build financial position first, then decide whether property strengthens it. That is not disrespect. That is adaptation. If you truly respect a principle, you adapt it to reality. You do not repeat the old form until it becomes harmful. This is important because many people feel guilty when they choose a different path. They feel like they are betraying family wisdom, but maybe they are honoring the deeper wisdom more accurately. If your family wanted you secure, do not buy insecurity just because it looks like their version of security. If your family wanted you stable, do not create fragility to satisfy their image of stability. If your family wanted you to build wealth, do not overpay for a symbol and call it wealth. Honor the purpose. Question the method. That is how you grow without arrogance. Now, let's return to the central trade. Permanence versus optionality. Permanence gives you a sense of continuity. Optionality gives you the ability to respond. Permanence says, this is my place. Optionality says, I can choose my next place. Permanence says, I am rooted. Optionality says, I am not trapped. Permanence can calm the nervous system. Optionality can protect the future. The right balance depends on your life stage. If you need roots, too much optionality may feel empty. If you need movement, too much permanence may feel suffocating. If you have a family structure that benefits from stability, ownership may carry value beyond financial return. If your career depends on mobility, ownership may cost more than the spreadsheet shows. If you are emotionally exhausted by uncertainty, a home may be worth a premium. If you are financially fragile, that same premium may be dangerous. There is no clean answer, only alignment. And alignment requires brutal honesty. Not brutal in the sense of self-punishment, brutal in the sense of removing the decoration. Here's the decorated version. I want to buy because it is a good investment. Here is the honest version. I want to buy because I am tired of feeling temporary, and I am willing to pay for permanence. That honest version may still justify buying, but it lets you price the emotional benefit correctly. Another decorated version. I am renting because it is financially smarter. Honest version. I am renting because I am not ready to commit, and I need to prove that I will actually use the flexibility to build wealth. Again, renting may still be right, but the honest version demands behavior. Another decorated version. I invest because I understand money. Honest version. I like the idea of investing, but I need to know whether I can handle losing 30% on paper without destroying my own plan. The honest version is more useful, because honesty creates design. Decoration creates self-deception, and self-deception is more dangerous than ignorance. Ignorance can learn. Self-deception resists learning. It builds arguments to stay the same. That is why this topic is uncomfortable. It forces people to examine not only their money, but their motives. And motives matter. A good motive cannot save bad math forever, but a hidden motive can ruin good math quickly. If you buy to impress, you may buy too much. If you rent to avoid responsibility, you may build nothing. If you invest to feel superior, you may take risks you do not understand. If you hold cash because you fear the future, inflation and missed opportunity may quietly punish you. If you take debt because you are impatient, time may become your enemy. The motive shapes the behavior shapes the outcome. So yes, numbers matter, but motives decide how you use the numbers. Now, as we move forward, we need to build a real decision framework. Not a formula, a framework. A formula tells everyone what to do. A framework helps each person see clearly. And the framework begins with one sentence. Do not ask what you can afford. Ask what you can sustain. Afford is the entry point. Sustain is the life point. Many people can afford the beginning of a decision. They cannot sustain the full life of it. They can afford the down payment, but not the repairs. They can afford the monthly payment, but not the loss of flexibility. They can afford the investment contribution, but not the emotional volatility. They can afford the rent, but not the absence of long-term accumulation. Sustainability is deeper than affordability. Affordability gets you in. Sustainability keeps you from being crushed once you are inside. The second sentence is, do not calculate only the asset. Calculate the system around the asset. A home inside a strong system can be excellent. A home inside a weak system can be dangerous. An investment plan inside a disciplined system can be powerful. An investment plan inside an impulsive system can fail. Renting inside a wealth-building system can be strategic. Renting inside a consumption system can become drift. The system decides. The third sentence is, do not confuse certainty with comfort. People often choose what feels certain, but what feels certain may only be familiar. Real estate feels certain to many people because it is physical. But physical does not mean risk-free. Markets feel uncertain because prices move visibly. But visible movement does not necessarily mean greater long-term danger. Sometimes the thing that shows you risk honestly is safer than the thing that hides risk until it is too late. That is a difficult idea, but important. A portfolio shows volatility. A property often hides it. A portfolio can be sold quickly, which tempts bad behavior. A property is hard to sell, which can force patience or trap you. Both have risks, different risks. You need to know which risk you are choosing. The fourth sentence is, do not let approval replace analysis. External approval feels good. Family approval, bank approval, social approval, cultural approval, online approval. But approval does not pay your bills. Approval does not maintain the property. Approval does not hold your portfolio during a crash. Approval does not give you emergency cash. Approval does not repair a bad decision. It only comforts you at the beginning. After that, you are alone with the structure. So build the structure for yourself, not for the applause. The fifth sentence is, the best decision is the one that still makes sense after the emotion fades. That is the test. If the home still makes sense after the dream feeling fades, good. If the rental strategy still works after the freedom feeling fades, good. If the investment plan still works after the excitement fades, good. If the decision only works while you are emotionally charged, wait. Emotion is not invalid, but it should not be the only fuel. Long commitments need more than excitement. They need design. And design is what we are moving toward now. In the next part, we will turn this into a practical framework. Not the shallow kind. Not buy if the payment is less than this percentage. That can help, but it is not enough. We need a deeper framework, one that includes cash flow, liquidity, mobility, psychology, opportunity cost, downside scenarios, and the hidden emotional reason behind the decision. Because the goal is not to make you afraid of buying. It is to make you impossible to fool. Impossible to fool by a sales pitch. Impossible to fool by an emotional slogan. Impossible to fool by family pressure. Impossible to fool by a spreadsheet that hides the wrong costs. Impossible to fool by your own impatience. Impossible to fool by the voice that says, just do it now. You will figure it out later, because sometimes you will figure it out later. And sometimes later is when the bill arrives. So let's build a serious framework. A framework that does not begin with the house. It begins with your position. Before asking whether you should buy, rent, or invest, you need to know where you actually stand. Not where you feel you stand. Not where you hope you stand. Not where your lifestyle makes it appear you stand. Where you actually stand. That means 5 things. Cash flow, liquidity, debt load, future flexibility, and emotional tolerance. If you do not know those 5, you are not ready to make a major housing decision. You may still make one. People do that all the time, but you are not making it from clarity. You are making it from fog. Let's start with cash flow. Cash flow is not income. This is one of the most important distinctions in personal finance. Income is what enters. Cash flow is what remains after your real life takes its share. And your real life is not the fantasy budget you write when you are trying to convince yourself something is affordable. Your real life includes food, transportation, family obligations, health, insurance, maintenance, clothing, emergencies, repairs, gifts, mistakes, fatigue, small pleasures, and the simple cost of being human. A budget that works only if you become a machine is not a budget. It is fiction. And many housing decisions are built on fiction. People calculate the monthly payment as if life will behave perfectly, as if nothing will break, as if they will never need rest, as if they will never help anyone, as if they will never have a medical expense, as if transportation will not rise, as if maintenance will wait politely, as if their income will arrive forever, on time, without interruption. That is not planning. That is hope with numbers. Real cash flow asks, after the payment, after the essential costs, after the predictable, irregular costs, after saving for maintenance, after investing, after keeping a life that does not make me miserable, what remains? That remainder matters because the remainder is your breathing room. And breathing room is not optional. People treat it like luxury. It is not. Breathing room is the difference between inconvenience and crisis. A car repair with breathing room is annoying. Without breathing room, it becomes debt. A medical bill with breathing room is stressful. Without breathing room, it becomes panic. A job transition with breathing room is difficult. Without breathing room, it becomes desperation. That is why cash flow is not just math. It is emotional protection. If a home destroys your breathing room, it may still build equity. But it may also build anxiety. And anxiety compounds too, not like money. Worse, it compounds inside your decisions. It makes you more reactive, more fearful, more likely to accept bad work, more likely to avoid healthy risks, more likely to argue, more likely to sell assets at the wrong time, more likely to say no to opportunities that could have improved your life. That is the hidden cost of tight cash flow. It does not just reduce your budget, it reduces your courage. And a financial decision that reduces your courage should be examined very carefully. Now, liquidity. Liquidity is boring until it becomes everything. Liquidity is the money you can actually use. Not theoretical wealth, not equity trapped inside walls, not a future sale that may take months, not an asset that requires negotiation, timing, taxes, fees, and luck. Usable money, available money, defensive money, optional money. People underestimate liquidity because it does not always produce a dramatic return. It just sits there. It looks lazy until your life changes. Then liquidity becomes oxygen. The emergency fund, the relocation fund, the opportunity fund, the I do not have to accept this bad deal fund, the I can survive while I think fund. That is not lazy. That is strategic. A person with liquidity can make better decisions because they are not cornered. A cornered person pays more, sells cheaper, accepts worse terms, and panics faster. So when you think about buying, do not ask only, can I gather the down payment? Ask, what happens to my liquidity after the purchase, after the down payment, after the closing costs, after the move, after furniture, after repairs, after the first surprises, after the emotional desire to make the place feel like yours? Many people calculate the purchase and forget the landing. The landing is expensive. The purchase does not end at the signature. It continues through the first months, when small costs appear everywhere. And if you enter that stage with no liquidity, the home begins to feel less like shelter and more like a machine asking for money. Again, not because the home is bad, because the structure was weak. A strong structure says, I can buy and still breathe. I can own and still have reserves. I can commit and still have options. If the purchase turns you into someone who owns an asset but fears every unexpected expense, you need to ask whether the asset is serving you or whether you are serving it. Next, debt load. Debt is not automatically bad. Debt is a tool. But it is a tool that changes the temperature of your life. Used well, it can help you access productive assets earlier. Used badly, it can make your future smaller. Debt has a psychological effect people often ignore. It creates obligation before income arrives. Your future money is already spoken for. Before you wake up, before you make choices, before you decide what kind of month you want. The payment is waiting. That can be fine if the payment is proportionate. But if the payment is too large, debt begins to colonize your future. It moves into your decisions. It sits in your job choices. It sits in your risk tolerance. It sits in your relationships. It sits in your sleep. It sits in the background of every idea that begins with, what if I tried something different? Debt answers, can you still pay? That question is not always bad. It can keep you disciplined. But if it becomes the master question of your life, something has shifted. You're not choosing freely anymore. You are negotiating with obligation. So the question is not, is debt good or bad? The question is Does this debt give me more power than it takes? Good debt should be proportionate, intentional, understandable, and survivable. Bad debt is often emotional, excessive, unclear, and dependent on everything going well. A mortgage can be either. That is why the phrase good debt is dangerous when used lazily. People hear that real estate debt can be good, and they stop asking whether their specific debt is good. But categories do not protect you. Specific terms do. Rate, payment, duration, income stability, emergency reserves, property quality, maintenance, exit options. Personal stage. A good category can still contain a bad deal. Never forget that. Now, future flexibility. This is the part that many calculators do not understand. A calculator can show you a payment. It cannot fully show you the cost of no longer being able to pivot. What if your career opportunity appears somewhere else? What if your relationship changes? What if your family needs change? What if you want to start a business? What if you realize the life you bought for is not the life you want? What if your industry shifts? What if your income becomes variable? What if the neighborhood changes in a direction you do not like? Flexibility is not about being unserious. It is about recognizing that the future is alive. If your future is highly uncertain, buying too rigidly can be risky. If your future is relatively stable, ownership may fit beautifully. The mistake is pretending your future has more certainty than it actually does. People do this because certainty feels good. They say, I will stay here. I will keep this job. My income will rise. I will want the same life. This area will improve. This payment will feel easier later. Maybe, but maybe not. A serious decision does not require pessimism. It requires ranges, a range of possible futures. If the decision works only in one narrow version of the future, it is fragile. If it works across several reasonable versions, it is stronger. That is how you evaluate, not by asking whether you can imagine a good future. Anyone can imagine a good future. Ask whether the decision survives a future that is only okay. Because okay is common. Average is common. Delays are common. Unexpected costs are common. Life being messier than planned is common. A good decision should not require a miracle. Now, emotional tolerance. This may be the most ignored part. Your personality matters. Some people can carry debt calmly. Others cannot. Some people can watch investments fall without panicking. Others cannot. Some people can rent without feeling unstable. Others feel psychologically exhausted by it. Some people can own a home and handle repairs as normal. Others feel attacked by every unexpected expense. Some people need roots. Some need movement. Some need automation. Some need constraints. Some need freedom. If you ignore your own psychology, you may choose a strategy that works in theory and fails in your actual life. That does not mean your psychology should control everything. Sometimes you need to grow. Sometimes you need to become more disciplined, less fearful, more patient, more informed. But growth should be designed, not assumed. Do not build a strategy that depends on a version of you that has never existed. If you have never saved consistently, do not casually assume you will rent and invest the difference without automation. If you panic during market drops, do not build a plan that requires heroic emotional discipline without safeguards. If debt keeps you awake, do not take the maximum mortgage because the spreadsheet says it might work. If you are easily influenced by social pressure, do not shop for homes while emotionally comparing yourself to everyone else. Know yourself, then design around yourself. A strategy that respects your weaknesses can outperform a perfect strategy that ignores them. That is not weakness. That is engineering. Now, after these 5 foundations, we can ask the housing question with more intelligence. The question becomes, does ownership strengthen my position across cash flow, liquidity, debt load, flexibility, and emotional tolerance? If yes, ownership may be powerful. If no, ownership may be premature, oversized, or misaligned. Notice the precision. Not good or bad, premature, oversized, misaligned. Those words are useful. A decision can be right later, but premature now. A home can be good, but too large for your current position. A location can be attractive, but misaligned with your future. A mortgage can be possible, but oversized relative to your emotional tolerance. This vocabulary helps you avoid absolutism. You are not saying, buying is bad. You are saying, this version of buying under these conditions does not fit. That is a much stronger conclusion, and it protects you from shame. Because shame makes people defensive. Precision makes people strategic. Instead of saying, I cannot buy, you might say, I am not ready to buy without damaging liquidity. That is different. Instead of saying, I am behind. You might say, I am building the position that will allow me to buy without desperation. Different. Instead of saying, renting is my only option, you might say, renting is currently preserving flexibility while I increase income and invest. Different. Instead of saying, I need a home now, you might say, I need stability, and I am evaluating whether ownership is the best way to obtain it. That is a higher level thought. The words matter because they shape your behavior. If you tell yourself you are behind, you may rush. If you tell yourself you are building position, you may act with discipline. If you tell yourself renting is failure, you may overbuy. If you tell yourself ownership is always maturity, you may ignore risk. If you tell yourself investing is always superior, you may ignore emotional and practical needs. Language can trap you. Use better language. Now, let's turn this into scenarios, not characters. Not a simple story of one buyer and one investor. That structure is too easy. Instead, think in systems. System 1. High income, low liquidity, high lifestyle spending, strong desire to buy, weak emergency reserves. This person looks strong because income is high. But the position may be fragile. If they buy aggressively, they could become dependent on income staying perfect. Their risk is not affordability on paper. Their risk is lack of resilience. For this person, buying may require lifestyle compression, liquidity rebuilding, and a smaller purchase than their ego wants. System 2. Moderate income, high savings discipline, low debt, strong liquidity, stable location needs, clear desire for permanence. This person may be a strong candidate for ownership even if they do not look wealthy. Why? Because structure matters. They have discipline. They have margin. They know what they want. They are not chasing status. They may buy conservatively and benefit from stability. System 3. Variable income, entrepreneurial ambitions, need for mobility, high tolerance for investing, no immediate need for roots. For this person, buying too early may create friction. Not because ownership is bad, because the life is still moving. Liquidity and optionality may be more valuable in this stage. System 4. Long-term renter, good income, no investments, no savings discipline, constant lifestyle inflation. Always says, buying is too expensive. This person may be using market difficulty as cover for lack of structure. Renting is not the problem. The absence of a wealth-building system is. System 5. Homeowner with manageable mortgage, emergency fund, diversified investments, long-term location fit, and emotional peace. That is a strong ownership structure. Not because ownership is magical, because the system is balanced. System 6. Homeowner with large mortgage, no reserves, no investments, high stress, and no ability to move. That is a fragile ownership structure. Not because owning is bad, because the asset consumed the system. These scenarios show the truth. The same decision changes meaning depending on the surrounding structure. That is why asking buy or rent is too crude. It is like asking whether a knife is good or bad. For a chef, useful. For a child, dangerous. For a surgeon, precise. For an angry person, catastrophic. The object is not enough. Context decides now. Let's address something many people feel, but rarely articulate: the shame of renting. In many cultures, renting carries a quiet stigma, not always explicit, but present. You feel it when someone asks, "Still renting?" You feel it when a relative says, "At your age, you should have something." You feel it when a friend buys and you congratulate them while quietly comparing your timeline. You feel it when you calculate and realize the home you want feels further away than expected. That shame can push people into decisions they are not ready for. Because shame wants escape. It does not want strategy. It wants relief. It says, just buy something so this feeling ends. But shame is not a reliable planner. Shame does not care whether the property fits. It does not care whether you have liquidity. It does not care whether your job is stable. It does not care whether the debt is too much. It only wants the social discomfort to stop, and that can be very expensive. So you need to separate practical urgency from emotional shame. Practical urgency says, the market conditions, my savings, my life stage, and this specific opportunity make action reasonable. Emotional shame says, I feel behind and buying will make me look less behind. Those are different. The first deserves analysis. The second deserves compassion and caution. Do not punish yourself for feeling it, but do not let it sign documents. Now there is also shame on the other side. The shame of buying something modest. People get approved for more and feel tempted to stretch. Not because they need more, because smaller feels like admitting limitation. But buying less than you can technically borrow may be one of the strongest financial moves you ever make. A smaller home with breathing room can be better than a larger home that owns your nervous system. A less impressive property with liquidity can be better than a dream property that turns every month into pressure. A practical choice that lets you invest, sleep, and adapt can be better than a beautiful choice that demands obedience. The market may reward patience. Life often rewards margin. And margin is easier to preserve when you do not let ego choose the size of the commitment. That is a hard lesson, because ego speaks fluently during major purchases. It says, "You deserve better. You are not working this hard for something modest. People will judge this. If you are going to buy something impressive. This is your chance to level up." Sometimes ego is pointing toward genuine ambition, but sometimes it is just inflating the invoice. Ambition asks, "What expands my life?" Ego asks, "What makes me look expanded?" Different question, different outcome. The same applies to investing. Ego says, "I can beat everyone. I understand the trend. I will enter before others. I will make back lost time. I do not need boring diversification." That ego can destroy people, because investing punishes arrogance eventually. Real estate does too, but often more slowly. The delay makes people think they were right longer. Slow consequences are still consequences. Now, let's discuss the biggest myth about stability. That stability means nothing changes. Real stability is not the absence of change. Real stability is the ability to absorb change without breaking. A tree that cannot bend may snap. A financial life that cannot adapt may collapse under pressure. A stable person is not someone who never moves. A stable person is someone who can move if needed and still remain intact. That is a very different definition. Under this definition, liquidity contributes to stability. Diversification contributes to stability. Skills contribute to stability. Low fixed costs contribute to stability. A reasonable home payment contributes to stability. A supportive network contributes to stability. Insurance contributes to stability. Health contributes to stability. Emotional discipline contributes to stability. A house alone does not create stability. It may support it, but if everything else is weak, the house becomes a heavy shell over a fragile system. This is why the framework must include multiple layers. Layer 1, survival stability, emergency fund, low bad debt, basic insurance where applicable, a clear understanding of monthly expenses. Layer 2, income stability, skills, employability, business resilience, multiple income possibilities if needed. Layer 3, liquidity and mobility, money available, ability to relocate, ability to take opportunities, ability to handle disruptions. Layer 4, asset building, investments, property, retirement accounts where available, business equity, productive tools. Layer 5, psychological stability, discipline, patience, ability to avoid panic, ability to resist comparison, ability to make decisions without needing applause. A home fits into this structure, but it should not erase the other layers. If buying strengthens several layers, good. If buying destroys the first 3 layers just to create a visible 4th layer, be careful. Because assets built on fragility may not protect you when pressure comes. Now, let's think about the timeline. A person may move through stages. Stage 1, build control, track spending, reduce destructive debt, create emergency reserves, learn basic investing, increase income where possible. Stage 2, build optionality, invest consistently, keep fixed costs reasonable, understand the housing market, define life direction. Stage 3, choose permanence if it fits, buy conservatively, maintain liquidity, keep investing, avoid becoming house poor. Stage 4, optimize, refinance if useful, rent part of the property if appropriate, invest surplus, diversify beyond the home. Use the home as one piece of a broader system. Not everyone follows this order. Some buy earlier, some rent longer, some invest first, some inherit, some start businesses, some move countries. The exact path varies, but the principle remains. Do not let one commitment destroy the system. That is the main rule. If you remember only one practical idea, remember that. Do not let one commitment destroy the system. A home is not a substitute for a financial system. It is part of one. Now we also need to talk about the dream of passive income from property. This dream is powerful. You buy a place, rent it out, someone else pays. You build wealth? Simple. Except it is not always simple. Rental property can be a serious business, but if you treat it like magic, it can punish you. There is vacancy, maintenance, bad tenants, legal complexity, insurance, taxes, repairs, management, time, stress, capital expenses, market changes, regulations, unexpected costs. The rent you receive is not the money you keep. That distinction matters. People love gross numbers. Reality lives in net numbers. Gross rent sounds exciting. Net return tells the truth. A property that looks profitable before expenses may be mediocre after them. A property that looks safe may depend heavily on one tenant. A property that looks passive may require active management. This does not mean rental property is bad. It means it should be treated like a business, not like a slogan. If you want rental income, you need reserves, contracts, screening, maintenance planning, legal awareness, realistic vacancy assumptions, a plan for repairs, time, or professional management. If you do not include those, you are not analyzing. You are fantasizing, and fantasy is not a strategy. The same applies to investing. Expected returns are not guaranteed. Average returns do not arrive in a straight line. Volatility is not a footnote. Taxes matter, fees matter. Behavior matters. Time horizon matters. Sequence of returns matters. Your need for cash matters. So whether it is property or markets, the adult question is, what remains after reality takes its share? That is the real return, not the headline, not the story, not the best-case scenario. What remains after costs, taxes, stress, time, risk, behavior, and opportunity cost? That is the number that matters. And sometimes, after you calculate honestly, the answer may surprise you. The path that looked boring may be strong. The path that looked impressive may be fragile. The path that looked flexible may be empty. The path that looked conservative may be risky. The path that looked risky may be manageable if sized correctly. This is why thinking matters. Now, let's bring this to the emotional center again. Why do people resist this analysis? Because clarity can take away fantasy, and fantasy is comforting. It is comforting to believe that one purchase will solve your future. It is comforting to believe that one investment strategy will outperform all messy life questions. It is comforting to believe that if you just choose the right category, you will be safe. But adulthood is the loss of simple categories, not the loss of hope. The loss of simple categories. You can still hope. You can still build. You can still buy. You can still invest. You can still create stability. But you stop demanding that one label save you. That is maturity, and it can feel disappointing at first, because nuance does not give the same dopamine as certainty. But nuance gives something better, protection. It protects you from overconfidence, from panic, from shame, from borrowed dreams, from old scripts, from financial theater, from decisions that look good but weaken you. In the next part, we need to go even deeper into one of the most important ideas in this entire conversation. The difference between being rich on paper and being free in real life, because many people are chasing net worth while quietly losing the ability to breathe. And if your wealth makes you more afraid, we need to ask what kind of wealth you are actually building. There is a difference between being rich on paper and being free in real life. This difference is easy to ignore when everything looks good, when the asset value is rising, when the home looks impressive, when the portfolio is growing, when people assume you are doing well, when the outside story feels clean. But the difference becomes very clear when pressure appears, because paper wealth does not always help you breathe. Paper wealth does not automatically pay an emergency. Paper wealth does not automatically let you leave a bad job. Paper wealth does not automatically reduce stress. Paper wealth does not automatically give you options. It depends on the form of that wealth. It depends on liquidity. It depends on debt. It depends on timing. It depends on whether you can access it without damaging yourself. A person can own a valuable home and still feel trapped. A person can have a large portfolio and still panic during a downturn. A person can have high income and still have no freedom because every dollar already has a destination. A person can look successful and still be financially fragile. This is why net worth alone is not enough. Net worth matters. Of course it matters. But net worth does not tell the whole story. It does not tell you how much of that wealth is liquid. It does not tell you how stressful the debt is. It does not tell you how much cash flow remains. It does not tell you whether the person can survive a bad year. It does not tell you whether the person is sleeping well. It does not tell you whether the person owns assets or whether the assets own the person. That line matters. Do you own the asset, or does the asset own your choices? A home owns your choices when every career decision must pass through the mortgage. A portfolio owns your choices when every market move controls your mood. A business owns your choices when you cannot leave it for a week without collapse. A lifestyle owns your choices when your image costs more than your peace. A debt owns your choices when it becomes the first voice in every decision. Ownership is supposed to mean control, but the wrong kind of ownership can become dependency. That is one of the great paradoxes of personal finance. You can own more and feel less free. You can have more and move less. You can build equity and lose optionality. You can increase status and reduce peace. You can become more impressive and more fragile at the same time. That is why the question is not only, how much do I own? The deeper question is, what does what I own allow me to do? That question changes the definition of wealth. A home that allows you to live peacefully, keep costs predictable, build equity, and maintain a healthy financial system can be real wealth. A home that consumes your income, destroys liquidity, limits mobility, and keeps you afraid of every expense may be wealth on paper and pressure in life. An investment portfolio that gives you long-term growth, liquidity, and strategic options can be real wealth. A portfolio that you check obsessively, trade emotionally, and cannot hold through normal volatility may be wealth in theory and anxiety in practice. Cash reserves that protect you from desperation can be real wealth. Cash held forever because you are afraid of every risk may become safety that quietly turns into stagnation. Everything has a shadow. That is why maturity means asking not just what something gives you, but what it does to you. A home does something to you. Debt does something to you. Liquidity does something to you. Renting does something to you. Investing does something to you. Waiting does something to you. Your financial structure shapes your personality over time. A high fixed payment can make you cautious. Sometimes wisely, sometimes excessively. A large emergency fund can make you calm, sometimes wisely, sometimes too comfortable. A volatile portfolio can make you patient if you understand it, or reactive if you do not. A home can make you grounded, or it can make you stuck. A rental life can make you flexible, or it can make you directionless. The tool shapes the user, and the user shapes the tool. That is why you cannot separate strategy from self-knowledge. If you want to build wealth that actually improves your life, you need to know what kind of pressure changes you. Some people become sharper under commitment. Some become resentful. Some become disciplined under a mortgage. Some become anxious. Some become motivated by investing. Some become obsessive. Some feel free while renting. Some feel unsettled. Some need permanence to thrive. Some need movement to breathe. You cannot ignore that. Because the best financial path is not the one that only wins in a mathematical model. It is the one that produces strength in your actual behavior. This is where a lot of expert advice becomes incomplete. It assumes an ideal person, a rational person, a disciplined person, a person who invests the difference, a person who holds through volatility, a person who does not overbuy, a person who reads contracts, a person who keeps emergency reserves, a person who calmly evaluates trade-offs. But many people are not that person yet. They are trying to become that person. And a strategy should account for the gap. Not excuse the gap forever. Account for it. If you know you are not disciplined yet, build automatic systems. If you know you panic, reduce exposure to panic triggers. If you know you compare yourself to others, reduce the inputs that feed comparison. If you know you overspend when cash is loose, create constraints. If you know debt makes you anxious, do not maximize debt. If you know uncertainty destroys your focus, maybe permanence has real value. A good strategy is not just a plan for your money. It is a plan for your behavior. Now let's talk about what freedom actually means in this context. Freedom is not doing whatever you want at every moment. That is impulse. Freedom is having enough structure that your choices are not constantly made from fear. Freedom is being able to say no. No to a bad job. No to a bad loan. No to an overpriced property. No to lifestyle pressure. No to a rushed investment. No to a family expectation that does not fit your life. No to panic. No to ego. No to the voice that says you are late. That is freedom. And sometimes freedom requires commitment. Sometimes it requires buying a home and reducing uncertainty. Sometimes it requires renting and keeping options open. Sometimes it requires investing steadily when nothing exciting is happening. Sometimes it requires holding cash while people mock cash. Sometimes it requires taking a calculated risk. Sometimes it requires refusing a risk that looks glamorous. Freedom does not always look like movement. Sometimes it looks like roots. And stability does not always look like roots. Sometimes it looks like mobility. This is why simplistic definitions fail. A person can be free in a home. A person can be trapped in a home. A person can be free while renting. A person can be lost while renting. A person can be free with investments. A person can be enslaved by market anxiety. The category does not decide. The internal structure decides. Now, consider the phrase, "I want security." Almost everyone says this in some form, but most people never define it. Do you mean emotional security, housing security, income security, family security, investment security, liquidity security, identity security, control, predictability, belonging? Because each type of security may require a different tool. If what you need is emotional grounding, a home may help. If what you need is liquidity, a home may not help first. If what you need is long-term growth, diversified investments may help. If what you need is protection from your own spending habits, forced equity may help. If what you need is mobility, ownership may hurt. If what you need is status, almost anything you buy will become dangerous because status never stops asking for more. You need to define the need before choosing the tool. Otherwise, you may use the wrong tool and then blame the tool. People do this constantly. They buy a home to feel safe, but what they actually needed was a stronger emergency fund and lower fixed costs. They invest to feel smart, but what they actually needed was a simple, boring plan they could stick to. They rent to feel free, but what they actually needed was direction. They avoid debt to feel safe, but what they actually needed was to learn how to use manageable debt strategically. They take debt to feel ambitious, but what they actually needed was patience. Wrong tool, wrong problem. That is how financial lives become messy. So before choosing, name the problem, not the surface problem. The real problem. Surface problem. I do not own a home. Real problem might be. I feel behind. Or, my rent is unstable. Or, I need family stability. Or, I do not know how to build wealth. Or, I am afraid my money is losing value. Or, I want proof that my work became something. Each real problem requires a different response. If the real problem is unstable rent, ownership may be a solution. If the real problem is feeling behind, ownership may only numb the feeling. If the real problem is lack of wealth-building knowledge, buying may not solve it. If the real problem is low income, a mortgage may intensify it. If the real problem is lack of discipline, a home may create forced discipline, but you should still understand that is what you are buying. Name the problem correctly, then choose. This is one of the most important habits in money. Do not solve the wrong problem expensively. A lot of people do. They solve shame with debt. They solve uncertainty with overcommitment. They solve boredom with speculation. They solve insecurity with status purchases. They solve lack of direction with a bigger lifestyle. They solve family pressure with a contract. The solution may look respectable, but if it answers the wrong problem, it eventually disappoints. Now let's build a practical decision map. Imagine 4 quadrants, not visually. Mentally, quadrant 1, high need for stability, strong financial position. This is where buying can make a lot of sense. If your income is stable, your payment would be manageable, you have liquidity, your life is geographically aligned, and ownership solves a real need, then buying may be strong. Not because buying is universally superior, because it fits the system. Quadrant 2, high need for stability, weak financial position. This is dangerous. The need is real, but the structure is weak. This person may desperately want a home, and emotionally, it makes sense. But if the purchase destroys liquidity and creates stress, the home may not produce the security they seek. For this person, the strategy may be to build position first. More savings, lower debt, higher income, smaller target, different timing, different location, more patience. Not because the desire is invalid, because the foundation is not ready. Quadrant 3, low need for permanence, strong financial position. This person has options. They may rent and invest. They may buy opportunistically. They may move for work. They may wait for better pricing. They may choose based on strategy rather than pressure. Their strength is optionality. The danger is drifting if they never convert optionality into direction. Quadrant 4, low need for permanence, weak financial position. This person is exposed. Renting may be necessary, but it is not automatically strategic. The focus should be survival stability first. Control spending. Build emergency reserves. Increase income. Eliminate bad debt. Start simple investing if appropriate. Avoid pretending that flexibility equals strength when there is no financial base underneath. This map is simple but powerful because it separates desire from position. And most bad decisions happen when desire outruns position. You want the thing before your structure can carry it. That is not a moral failure. It is a sequencing problem, and sequencing problems can be solved. Not instantly, but strategically. You may need a smaller home, a later purchase, more liquidity, more income, more discipline, a different city, a different expectation, a different mix of renting and investing, a different definition of enough. Enough is a powerful word, because many people never define enough. They say they want a home, but how much home? How much space? How much location? How much status? How much comfort? How much debt? How much sacrifice? If you do not define enough, the market will define more. The bank may approve more. The seller may encourage more. Your ego may demand more. Your comparison may push more. And more is not always better. More house can mean less life. More space can mean less liquidity. More prestige can mean less peace. More permanence can mean less adaptability. Enough is the boundary that protects you from endless appetite. Financial health often depends on knowing when enough is enough. This applies beyond housing. Enough car, enough lifestyle, enough risk, enough cash, enough work, enough consumption, enough status. If you cannot define enough, you will always be vulnerable to more. And more will call itself progress. But progress is not simply larger. Progress is better aligned. A smaller decision that fits can be more advanced than a larger decision that strains everything. A modest home bought well can be more mature than a dream home bought badly. A boring investment plan followed for years can be more powerful than a clever strategy abandoned in panic. A rental life with strong wealth building can be more serious than ownership built on appearances. Alignment beats size. That is a phrase worth remembering. Alignment beats size. Now, let's talk about timing. People often treat timing as market timing. Should I buy before prices rise? Should I wait for rates? Should I enter the market now? Should I invest now? Those questions matter, but personal timing matters just as much. Maybe the market is attractive, but your life is not ready. Maybe your life is ready, but the specific deal is bad. Maybe the deal is good, but the debt structure is wrong. Maybe the property is good, but the location does not fit your future. Maybe the investment opportunity is strong, but you need emergency reserves first. There are multiple clocks: market clock, personal clock, career clock, family clock, debt clock, emotional clock, liquidity clock. A good decision aligns enough of these clocks, not perfectly. Perfect alignment rarely happens, but enough. If only one clock is screaming, be careful. If the market clock says now, but your liquidity clock says not ready, listen. If your social clock says you are late, but your financial position says build first, listen. If your emotional clock says I need relief, but the numbers say too much, listen. If your career clock says mobility matters, but the home says stay, listen. Listening does not always mean obeying. It means respecting the signal. Many people listen only to the loudest clock, usually fear. Fear is loud, but fear is not always wise. It sees danger quickly. It does not always choose well. So slow down, not forever, just enough to let the quiet signal speak. Liquidity speaks quietly. Opportunity cost speaks quietly. Future flexibility speaks quietly. Emotional sustainability speaks quietly. Your ego speaks loudly. Your fear speaks loudly. The seller speaks loudly. The market narrative speaks loudly. Online certainty speaks loudly. But the quiet signals often decide the long-term outcome. That is why intelligent decisions often feel less dramatic than bad ones. Bad decisions are exciting, but they rush, they promise, they relieve, they create a story. Good decisions can feel boring. They wait, they measure, they preserve margin, they disappoint ego. They refuse to turn urgency into identity. But boring is underrated. Boring can build. Boring can compound. Boring can protect. Boring can keep you from becoming the person who has to fix a dramatic decision later. Now, let's examine the emotional price of permanence. When you buy a home, you are not only buying shelter, you are buying a relationship with a place. That relationship can be beautiful. It can give rhythm to your life. It can create memories. It can make your days feel less temporary. But relationships require maintenance. With a home, that maintenance is literal and financial. The place ages, the systems age, the neighborhood changes, your needs change, your taste changes, your household changes. The relationship must be renewed. If you entered the relationship expecting only comfort, you may resent the work. If you entered understanding the work, you may handle it. This is another way to think about ownership. Ownership is not possession. Ownership is responsibility. You do not just get the asset. You get the obligation to care for it. That is obvious, but emotionally underappreciated. People imagine the peace of ownership. They do not always imagine the administration of ownership. The calls, the repairs, the decisions, the unexpected costs, the paperwork, the taxes, the planning, the choices. For some, this is fine, even satisfying. For others, it becomes a burden. Know which person you are. Do not buy the fantasy version of yourself who loves managing everything if the real version of you hates administrative responsibility. This matters even more with rental property. Because rental property is not passive in the way beginners imagine. It may become systematized. It may be managed. It may generate income. But it is not magic. It is an operating asset. If you do not want operations, be careful calling yourself a real estate investor. You may not want real estate. You may want the idea of real estate. Very different. The same applies to investing. If you do not want to study individual companies, do not pretend you will enjoy managing a complex portfolio. If you do not want volatility, do not choose aggressive assets just because the return sounds attractive. If you do not want to think about markets, maybe you need simple, diversified automation, designed for your real temperament. Now, let's talk about the hidden emotional cost of investing. Because we have been hard on ownership, and we need balance. Investing can feel lonely, especially when people around you value physical proof. You may be doing the right thing and still feel like nothing is happening. You may be building wealth in silence while someone else posts keys. You may understand compounding, but your nervous system still wants visible progress. You may feel foolish during market downturns. You may feel behind because your wealth does not look like a room you can stand inside. That emotional difficulty is real, and if you ignore it, you may abandon the plan. So an investment strategy needs emotional design, automation, clear rules, time horizon, diversification, a written reason for investing, an understanding of volatility, a plan for downturns before downturns happen, and maybe most importantly, a way to stop comparing visible assets to invisible accumulation, because comparison can destroy good strategy. If you are investing instead of buying, you need to know why. Not vaguely, clearly. You need to say, I am preserving liquidity because my career requires flexibility. Or, I am building capital before buying. Or, I prefer diversified exposure right now. Or, I am not ready for ownership responsibilities. Or, I am renting below what ownership would cost and investing the difference. The reason must be strong enough to survive social pressure. If your reason is weak, pressure will break it. You will see someone buy and feel behind. You will hear a relative criticize renting and feel doubt. You will watch property prices rise and feel panic. You will think, maybe I am making a mistake. Maybe you are. Maybe you are not. But without a clear framework, you will not know the difference. You will only feel, and feelings change. A framework stabilizes you when feelings move. Now, let's revisit the idea of wealth as options. Imagine two people. One has a beautiful home, but cannot miss 1 month of income without panic. The other rents modestly, has strong investments, cash reserves, and the ability to move, but owns no home yet. Which one is wealthier? The obvious answer depends on net worth. The deeper answer depends on freedom, risk, and resilience. Maybe the homeowner has more net worth. Maybe the renter has more usable power. Maybe one is better positioned today. Maybe the other is better positioned in 20 years. You cannot know from the label. You need the structure. That is the point. We should stop asking shallow questions. Do you own? Do you rent? Are you invested? Instead ask, can your life absorb stress? Are you building assets? Do you have liquidity? Can you adapt? Do your commitments match your income? Are you making decisions from fear or clarity? Are you becoming more free over time? That last question may be the best one. Are you becoming more free over time? Not necessarily more comfortable. Not necessarily more impressive. More free. Free from desperation. Free from bad debt. Free from social pressure. Free from panic. Free from avoidable fragility. Free from needing every month to go perfectly. Free from the need to prove success through visible objects. If your housing decision moves you toward that freedom, good. If it moves you away from it, reconsider. Now, as we move toward the final framework, we need to name the most dangerous sentence in personal finance. I will figure it out later. Sometimes that sentence is courage. Often it is avoidance. You say it when the numbers feel uncomfortable. You say it when you do not want to confront the full cost. You say it when desire is stronger than structure. You say it when you are afraid that if you calculate honestly, the dream may shrink. But dreams that cannot survive honest calculation are not ready. They may become ready later, but not yet. A serious dream gets stronger when measured. A fragile fantasy breaks. Let it break early if it must. Better a fantasy breaks before you sign than your life breaks after. That may sound harsh, but it is protective. Because there is no honor in forcing a dream that your life cannot carry. There is honor in preparing properly. There is honor in adjusting. There is honor in choosing smaller. There is honor in waiting with discipline. There is honor in buying with margin. There is honor in saying, I want this, but not like this. That sentence is powerful. I want this, but not like this. It preserves the dream and rejects the dangerous version. Use it when the home is too expensive, when the debt is too heavy, when the investment is too speculative, when the timing is too rushed, when the pressure is too emotional. I want this, but not like this. That is not weakness. That is financial self-respect. In the next part, we will build the final decision architecture. The one that turns this entire conversation into a practical way to choose, not a slogan, not a side, a way to decide without letting fear, status, or old scripts take control. Now we need to turn this into a way to decide, not a rule, not a slogan, not a borrowed belief. A decision architecture, because the person who owns a decision architecture is harder to manipulate, harder to rush, harder to shame, harder to impress with surface-level certainty, harder to trap inside an old script. And that matters, because money is not only lost through bad math. Money is lost through bad pressure. Pressure to buy, pressure to keep up, pressure to look successful, pressure to invest in what everyone is talking about, pressure to prove you are not behind, pressure to act before you understand, pressure to stay consistent with an identity that no longer fits. A good decision architecture slows that pressure down. It creates space, and space is where better decisions happen. So the first layer is simple. Define the real objective, not the object, the objective. A home is an object. Security is an objective. A portfolio is an object. Freedom is an objective. Cash is an object. Optionality is an objective. Debt is a tool. Leverage is a tool. Renting is an arrangement. Stability is an objective. Do not confuse objects with objectives. This is where many people go wrong. They say, I want a home. But the deeper objective might be, I want stability. Or, I want proof that my work has become something. Or, I want to stop feeling temporary. Or, I want protection from future rent increases. Or, I want a place for my family. Or, I want an investment. Those are not the same objective. And because they are not the same, they should not automatically lead to the same decision. If your objective is emotional grounding, the answer may be different than if your objective is maximum financial flexibility. If your objective is investment return, you must analyze the property differently than if your objective is quality of life. If your objective is family stability, you may accept financial inefficiency that would be unacceptable for a pure investment. If your objective is wealth accumulation, you may need to compare ownership against diversified alternatives more rigorously. If your objective is status, stop. Do not make a long-term financial commitment until you admit that status is driving. Status is one of the most expensive objectives because it never feels satisfied. It always finds someone with more, a better location, a larger place, better finishes, a more impressive lifestyle. Status turns enough into almost enough, and almost enough is a trap. So before anything else, name the objective. Say it plainly. I am buying for stability. I am renting for mobility. I am investing for long-term optionality. I am waiting to strengthen my position. I am considering ownership because I want roots, not because I think it is automatically the best investment. Honest objectives create honest analysis. The second layer is separate emotional value from financial value. A home can have both, but do not mix them carelessly. Financial value asks, what is the price? What is the debt cost? What is the likely maintenance? What is the exit strategy? What is the opportunity cost? What is the rent alternative? What is the expected long-term benefit? What is the downside? Emotional value asks, will this improve my daily life? Will this give me peace? Will this create stability for my family? Will this help me feel grounded? Will this reduce uncertainty? Will this support the life I actually want? Both sets of questions matter, but they should not be confused. If the financial case is weak, but the emotional value is high, you may still choose it. But say that. Do not pretend it is a perfect investment. Say, I am paying for quality of life. That is allowed. Adults can pay for quality of life. The problem is when they call every emotional premium an investment. That hides the true cost, and hidden costs are dangerous. The reverse is also true. If the financial case is strong but the emotional fit is terrible, be careful. A great spreadsheet can still produce a miserable life. A property may be cheap for a reason. An investment may be rational, but psychologically unbearable. A rental strategy may be efficient, but leave you feeling unstable in a way that damages your focus. The point is not to remove emotion. The point is to make emotion visible. Visible emotion can be priced. Hidden emotion controls you. The third layer is test the downside before celebrating the upside. Most people do the opposite. They imagine appreciation. They imagine freedom. They imagine stability. They imagine returns. They imagine being right. Then they treat risk as a small footnote. This is backwards. The downside deserves attention first. Ask, if this goes worse than expected, what happens to me? Not what happens on paper. What happens to me? Do I lose sleep? Do I lose liquidity? Do I lose flexibility? Do I need to borrow at bad terms? Do I become dependent on one income source? Do I need to sell under pressure? Do I become unable to leave a bad situation? Do I damage relationships? Do I abandon investing? Do I become resentful? Do I become trapped? If the downside is survivable, you can think about upside. If the downside is life distorting, be careful. People often say, but every decision has risk. Yes, but not every risk has the same consequence. A temporary decline in a diversified investment you do not need to sell is different from a payment that pushes you into panic every month. A maintenance surprise with reserves is different from the same surprise with no cash. A rent increase with mobility and savings is different from a rent increase when you are already stretched. A job loss with a low fixed costs is different from a job loss with a large mortgage. Risk is not just probability. Risk is impact, and impact depends on your position. That is why strong position matters so much. It turns some disasters into inconveniences. Weak position turns inconveniences into disasters. The fourth layer is calculate the after-decision life, not just the decision. People calculate the purchase. They forget the life after the purchase. They calculate the investment. They forget the emotional life during volatility. They calculate the rent. They forget the discipline required to invest the difference. The after-decision life is the real test. After buying, can you still save? Can you still invest? Can you still handle emergencies? Can you still enjoy life reasonably? Can you still maintain the home? Can you still move if needed? Can you still take professional risks? Can you still sleep? After renting, are you actually investing? Are you building reserves? Are you using mobility? Are you avoiding lifestyle inflation? Are you moving toward a stronger position? After investing, can you hold through downturns? Can you avoid panic selling? Can you avoid chasing trends? Can you keep contributing when it feels boring? Can you accept that wealth may be invisible for a while? The after-decision life reveals whether the strategy is real. A plan that works only before real life begins is not a plan. It is a pitch. The fifth layer is identify the hidden identity behind the decision. This is uncomfortable, but necessary. Ask yourself, who am I trying to become by making this choice? A responsible adult? A successful person? A free person? A sophisticated investor? A stable partner? A person who is not behind? A person who proved something to family? A person who escaped uncertainty? There is nothing wrong with identity. Humans need identity, but identity should not be purchased blindly. Because if a decision is mostly about identity, you may overpay. You may choose the version that looks most like the identity, not the version that best supports your life. This is why someone buys more house than needed. Not because the extra space is essential, because the bigger house better matches the identity. This is why someone refuses to buy even when it fits. Not because renting is objectively better, because ownership conflicts with the identity of being free. This is why someone takes risky investments, not because the risk is appropriate, because the identity of being early, smart, or bold feels attractive. Identity is a powerful financial force. Do not let it operate in the dark. The sixth layer is designed for your actual behavior. We touched this before, but now it becomes practical. If you rent and invest, automate contributions before you spend. If you buy, create maintenance reserves automatically. If you invest, write a downturn plan before the downturn. If you are tempted by status, set a maximum purchase range before shopping. If you panic easily, avoid checking investments constantly. If you overspend when cash accumulates, separate accounts. If you are too conservative, create a rule for gradual risk-taking. If you are too aggressive, create rules that force cooling periods. Your behavior needs architecture. Willpower is not enough. Willpower is emotional. Architecture is structural. And structural beats emotional when the decision spans years. The seventh layer is create exit awareness. Not necessarily an exit plan for tomorrow, but awareness. How hard would it be to reverse this decision? If you buy, how costly is selling? How liquid is the market? What fees exist? What taxes or transaction costs matter? Could you rent it if needed? Could you carry it if vacant? Could you downsize? Could you refinance? If you rent, what happens if rent rises? How quickly can you move? What does moving cost? If you invest, what money is short-term and what money is long-term? What assets should not be touched? What happens in a market decline? Exit awareness does not mean pessimism. It means you understand that life changes. A decision with no exit can still be fine, but only if you are aware of what that means. The eighth layer is check whether the decision increases or decreases your ability to say no. This may be the most powerful test. After this decision, can you say no more easily or less easily? No to a bad job. No to a bad client. No to a bad relationship dynamic. No to a bad investment. No to family pressure. No to panic. No to unnecessary consumption. No to an overpriced deal. If the decision makes you less able to say no, it may be reducing your freedom. If it makes you more able to say no, it may be strengthening your position. This is why liquidity matters. This is why manageable debt matters. This is why low fixed costs matter. This is why strong investments matter. This is why a reasonable home can matter. A good financial system gives you better no's, and better no's create better yeses. The ninth layer is ask whether the decision still works if nobody praises it. This removes performance. If nobody sees the home, is it still worth it? If nobody understands the investment strategy, is it still worth following? If nobody respects your choice to rent, does it still serve your life? If nobody congratulates you for waiting, can you still stay disciplined? Many weak decisions need applause. Strong decisions can survive without it. That does not mean you should not enjoy support. It means the decision should not depend on it. The 10th layer is make the decision reversible in your mind before it is reversible in reality. This sounds strange. It means do not attach your identity so tightly to the decision that you cannot evaluate it later. If you buy, you are allowed to review whether it still fits. If you rent, you are allowed to change when the time comes. If you invest, you are allowed to simplify or adjust. If you wait, you are allowed to stop waiting. You are not betraying yourself by updating your strategy. You are protecting yourself. Rigid identity creates bad finance. Flexible principles create better finance. Now, if we combine all of this, the decision architecture sounds like this. What is my real objective? What is the emotional value? What is the financial value? What is the downside? What does life look like after the decision? What identity am I trying to buy? How will my actual behavior affect the outcome? What are my exits? Does this increase my ability to say no? Would I still choose it without applause? Can I update later without ego? That is a serious framework. It will not give you a one-word answer, but it will reveal the quality of the decision. And that is better, because one-word answers are often too cheap for decisions that expensive. Now, let's apply this framework to the big paths. First, buying a home to live in. This can be a strong decision when the objective is clear. Stability, long-term location fit, quality of life, protection from certain rental uncertainties, a desire for roots, a manageable payment, enough liquidity after purchase, a realistic maintenance plan, a long enough horizon, a debt level that does not destroy courage, a home size chosen by life fit, not ego. If those pieces align, ownership can be powerful. It can give psychological peace. It can create a base. It can build equity. It can stabilize housing costs in certain ways. It can support family life. It can be deeply worth it. But the same path becomes dangerous when the objective is shame relief, when the payment is stretched, when there is no emergency fund, when the person assumes appreciation will solve everything, when the property is chosen for status, when buying eliminates all investing capacity, when the person ignores mobility needs, when the decision depends on perfect income, when the buyer says, "I will figure it out later," too many times. That is not the same decision, same category, different structure. Second, renting while investing. This can be strong when rent is reasonable, the difference is actually invested, liquidity is preserved, mobility has value, and the person has discipline. It can be excellent for someone building income, growing a business, staying flexible, or avoiding an overpriced purchase. But it becomes weak when the investing part does not happen. When flexibility becomes lifestyle inflation. When the person avoids commitment without building assets. When rent consumes too much income. When there is no plan to handle rising housing costs. When the person uses renting is smarter as a slogan instead of a system. Again, same category, different structure. Third, buying rental property. This can be powerful when treated like a business. Realistic numbers, vacancy assumptions, maintenance reserves, legal understanding, tenant screening, management systems, financing that survives stress, a clear return target, a plan for major repairs. It can build wealth. But it becomes dangerous when treated like passive magic, when gross rent is confused with profit, when the buyer ignores time, when there are no reserves, when leverage is too high, when the person is emotionally unprepared for tenant issues, when the property only works under ideal assumptions. Fourth, investing in financial markets. This can be powerful when diversified, consistent, long-term, low-cost, and aligned with risk tolerance. It can scale. It can remain liquid. It can compound. It can be simpler than property management. But it becomes dangerous when the person chases trends, panics during downturns, concentrates too much, invests money needed soon, or confuses recent performance with permanent truth. Fifth, waiting. Waiting can be powerful when it is active, saving, learning, increasing income, building reserves, studying markets, improving credit, clarifying life direction, reducing debt, investing. Waiting can also be a trap when it is passive. No plan, no saving, no investing, no learning. Only fear wearing the costume of patience. These distinctions matter because you may discover that the problem is not your chosen path. It is the version of the path you were about to choose. A better version may exist. A smaller home, a longer preparation period, a clearer investment plan, a hybrid strategy, a different location, a different timeline. A lower fixed cost, a better emergency fund, a more honest objective, a stronger system. The goal is not always to abandon the dream. Sometimes the goal is to redesign it so it does not crush you. This is where many people need emotional permission. You can want a home and still reject the wrong home. You can want stability and still refuse an unstable mortgage. You can want freedom and still build commitments. You can want wealth and still avoid a risky trend. You can want to invest and still keep cash. You can want to buy later and still rent now without shame. You can want roots and still admit you are not ready. The mature sentence is, I want this, but only in a form my life can sustain. That sentence protects dreams from becoming traps. Now let's address the feeling of being late. This feeling drives many housing decisions. People look around and feel that everyone else is ahead, but you rarely see the full balance sheet of another life. You see the purchase, not the debt. You see the home. Not the help they received. You see the renovation, not the stress. You see the vacation, not the credit card. You see the investment win, not the losses. You see the confidence, not the anxiety. Comparison gives you incomplete data and then asks you to make emotional conclusions. That is a terrible system. Do not make financial decisions based on someone else's edited evidence. You need your own numbers, your own timing, your own objectives, your own structure. Being late compared to a false image is not being late. It is being manipulated by partial information. And sometimes you are not late. You are early in a different strategy. Maybe your wealth is not visible yet. Maybe your discipline is still compounding. Maybe your position is getting stronger quietly. Maybe you avoided mistakes other people have not yet paid for. Maybe you are not behind. Maybe you are building invisibly. But this is only comforting if it is true. If you are using that idea to excuse inaction, it becomes another lie. So be honest. Are you building invisibly or drifting invisibly? There is a big difference. Invisible building has evidence, savings, investments, debt reduction, skill growth, income growth, better habits, clearer decisions. Invisible drifting has excuses, big ideas, no execution, criticism of the market, no plan, no accumulation, no discipline. Do not confuse them. Now, let's return to the housing affordability problem more broadly. It is real in many places that housing has become harder to access relative to income. This is not just individual weakness. It is not always because people are lazy, wasteful, or irresponsible. In many markets, the relationship between housing prices, rents, incomes, credit costs, and available supply has become more difficult. That matters. A serious person can admit the structural problem without surrendering individual agency. Those two truths can coexist. The system can be harder. Your decisions still matter. Prices can be distorted. Your spending still matters. Supply can be limited. Your income strategy still matters. Credit can be expensive. Your debt choices still matter. Investors can influence markets. Your preparation still matters. If you focus only on the system, you may become passive. If you focus only on yourself, you may become cruel to yourself. The adult view holds both. This is difficult, but necessary, because personal finance advice often over-individualizes problems. It tells people, just budget better. Sometimes that helps. Sometimes it ignores the scale of the issue. On the other hand, social criticism often removes individual power. It says, the system is broken. Sometimes that is valid, but if that conclusion leads to no action, it becomes a cage. You need both lenses, structural awareness, personal strategy. One without the other is incomplete. Structural awareness without personal strategy becomes despair. Personal strategy without structural awareness becomes naive. Together, they create realistic agency. Realistic agency says, I may not control the whole market, but I control how prepared I am. How much I understand, how I manage debt, how I build income, how I use flexibility, and whether I let pressure make decisions for me. That is a strong position. Not omnipotent, strong. And strong is enough to begin. Now, if housing is harder, the response cannot be simply, work harder. It must be, think wider. Maybe the path is not one big purchase. Maybe it is staged. Rent, invest, build reserves, buy later. Buy smaller? Keep liquidity, invest alongside. Buy with a plan to create income. Move to a more aligned location. Increase income before buying. Avoid ownership until career direction stabilizes. Build a portfolio first. Buy only when the payment is below your stress threshold. Use property as a home, not as an identity. There are many paths. The key is that the path must be coherent. Coherence beats intensity. Many people act intensely for a short time and then collapse. They save aggressively for 3 months, invest emotionally, shop obsessively. Panic. Stop. Restart. Coherence is different. It is quieter. It is repeatable. It is less dramatic. It builds. Every month, every decision, every refusal, every adjustment. A coherent person may look slower, but they are often stronger because they are not relying on emotional bursts. They are relying on systems. This is how wealth is actually built for many people. Not through one dramatic decision, but through repeated coherence. Spend less than you earn. Increase what you earn. Keep bad debt controlled. Invest consistently. Avoid catastrophic commitments. Keep reserves. Learn. Adjust. Do not panic. Do not perform wealth you do not have. Do not confuse complexity with sophistication. Do not let shame run the budget. Simple principles, difficult execution, and housing must fit inside those principles. If housing breaks them, it is too heavy. If housing supports them, it may be excellent. Now, let's prepare for the final part. The final question will not be, should you buy? It will be, what decision makes you more capable of living the life you claim to want? That is the highest question. Because money is not just about accumulation. It is about capability. Can you live? Can you adapt? Can you rest? Can you build? Can you help? Can you move? Can you stay? Can you say no? Can you say yes? Can you survive imperfection? Can you think clearly under pressure? A financial decision that increases your capability is valuable. A financial decision that reduces your capability while improving your appearance is dangerous. This is the line. Capability over appearance, position over proof, structure over slogan. And in the final part, we will close with the most uncomfortable idea of all. The most expensive home is not always the one with the highest price. Sometimes, the most expensive home is the one that quietly buys your future options before you realize they were for sale. It buys your ability to move, your ability to wait, your ability to change, your ability to take a risk, your ability to leave, your ability to breathe. Your ability to say no. And the dangerous part is that, at the beginning, it does not feel like losing options. It feels like gaining something. A home, a milestone, a story, a symbol, a reason to feel proud. And maybe all of that is real. But if the price of that symbol is too much of your future flexibility, you need to be honest about what you are exchanging. Because the real transaction is not only between you and a seller. It is between your present self and your future self. Your present self wants relief. Your future self needs options. Your present self wants certainty. Your future self needs resilience. Your present self wants proof. Your future self needs a system. And a wise decision is one that does not betray the future self just to comfort the present one. That is difficult, because the present self is loud. It feels the pressure now. It hears the comments now. It sees other people moving now. It feels the shame now. It wants the answer now. The future self is quiet. It does not scream. It waits. And then, years later, it either thanks you for protecting it or pays for the fact that you ignored it. That is why major financial decisions require imagination, not fantasy. Imagination. The ability to imagine the ordinary life after the exciting decision. Not the day you buy. Not the day you post. Not the day people congratulate you. The ordinary Tuesday, 3 years later. The month when something breaks. The year when your career shifts. The season when you want to take a risk. The moment when an opportunity appears and you ask, can I afford to move? Can I afford to change? Can I afford to say yes? Can I afford to say no? The answer to those questions may depend on what you decided years earlier. This is the hidden power of financial architecture. It prepares a version of you that does not exist yet. And that version of you will live inside the consequences. So let's bring everything together. A home can be one of the most meaningful things you ever buy. It can be shelter. It can be memory. It can be a place where life becomes more grounded. It can protect your family. It can stabilize your routine. It can build equity. It can reduce certain uncertainties. It can become part of your identity in a healthy way. It can be worth more than a spreadsheet can show. But a home can also become too heavy. It can make your life smaller. It can absorb your liquidity. It can reduce your mobility. It can increase stress. It can concentrate your wealth. It can force you to protect a decision that no longer fits. It can make you look stable while you become fragile. Both are true. That is why the decision deserves respect, not fear. Respect. Renting can be a waste if it becomes years of consumption with no plan. It can also be strategic if it preserves capital, flexibility, and movement while you build assets. Investing can be powerful if it is disciplined, diversified, and long-term. It can also become chaos if it is driven by panic, ego, and trends. Debt can build if it is proportionate and intentional. It can trap if it is oversized and emotional. Waiting can protect you if it is active. It can weaken you if it is avoidance. No path is innocent. No path is holy. No path saves you automatically. You have to bring structure to it. And that may be the most important message in this entire script. The tool does not save you. The structure does. A home without structure can become pressure. A portfolio without structure can become panic. Renting without structure can become drift. Debt without structure can become obedience. Cash without structure can become stagnation. Ambition without structure can become self-destruction. Structure is what turns a choice into a strategy. So before you choose, ask, what is the structure? What is the objective? What remains after the decision? What happens if life does not go perfectly? What does this do to my ability to say no? What part of my identity is involved? What am I sacrificing? What am I protecting? What future version of me will live with this? These are not easy questions, but easy questions often create expensive answers. And if there is one thing you should stop doing after listening to this, it is making large decisions from small phrases. Renting is throwing money away. Too small. Real estate always wins. Too small. Just invest. Too small. Debt is bad. Too small. Debt is how rich people get richer. Too small. Buy before it is too late. Too small. Wait until everything is perfect. Too small. Your life is too complex for those phrases. Your future is too valuable for slogans. A slogan may start a conversation. It should not sign a contract. What should sign the contract is clarity, not perfect certainty. That does not exist. Clarity. Clarity about the cost. Clarity about the risk. Clarity about the reason. Clarity about the trade-off. Clarity about the life you are choosing. And clarity may tell you different things at different stages. At one stage, clarity may say, do not buy yet. At another stage, it may say, buy but smaller. At another, buy now. This fits. At another, I sell. The asset no longer serves the life. At another, rent and invest seriously. At another, stop pretending flexibility is a plan. At another, stop pretending ownership is maturity. That is why a real financial philosophy cannot be rigid. It needs principles, but it must adapt. The principle is not, Always buy, always rent, always invest, always avoid debt, always use leverage. The principle is, build a life that becomes stronger over time. Stronger in resilience, stronger in options, stronger in wisdom, stronger in emotional discipline, stronger in financial position. If buying makes you stronger, buy. If renting while investing makes you stronger, rent and invest. If waiting makes you stronger because you are preparing, wait. If waiting is making you weaker because you are avoiding, stop waiting. If debt makes you stronger because it is measured and productive, use it carefully. If debt makes you obedient to fear, reduce it. That is the real game. Strength over status, capability over appearance, freedom over applause. Now, let's face the cultural pressure one last time. There will always be people who reduce your life to visible milestones. Do you own? Are you married? Do you have the car? Do you have the title? Do you have the business? Do you have the proof? But the people asking these questions rarely carry the full cost of the answers. They do not pay your mortgage. They do not sit with your stress. They do not absorb your opportunity cost. They do not rebuild your liquidity. They do not live inside your anxiety. They do not repair your overcommitment. So their approval should not have voting power over your future. Listen to people. Learn from people. Respect experience. But do not surrender your decision. Because the person who does not pay the consequences does not get final authority. That sentence can save you. The person who does not pay the consequences does not get final authority. This includes family, friends, online voices, cultural expectations, and even the insecure version of yourself that wants approval at any cost. Your future deserves better leadership than that. It deserves the part of you that can pause, calculate, question, admit fear, admit desire, admit uncertainty, and still choose with dignity, not perfectly, with dignity. Because dignity in finance is not about never struggling. It is about not lying to yourself while you struggle. It is about not pretending a decision is wise just because it is popular. It is about not calling fear ambition, not calling ego strategy, not calling avoidance patience, not calling status stability, not calling fragility success. That honesty changes everything. Now, if you are young or rebuilding or starting late or feeling behind, hear this clearly. Being behind a social timeline is not the same as being doomed. But feeling behind can make you do doomed things. It can make you overborrow, overbuy, overinvest, undersave, take bad risks, avoid reality, compare constantly, give up too early, or chase a version of success that was never designed for your life. Do not let the feeling of being late make you financially reckless. Late is not fatal. Reckless can be. If you need more time, use it well. If you need to rent, rent with a plan. If you need to build income, build it. If you need to learn, learn. If you need to downsize expectations, do it. If you need to buy smaller, do it. If you need to stop waiting, move. But do not surrender to shame. Shame is a poor architect. It builds ugly futures. Use truth instead. Truth may say, "You are not ready." That hurts, but it helps. Truth may say, "You can buy, but not the version your ego wants." That hurts too. Truth may say, "You are using flexibility as an excuse." Useful pain. Truth may say, "You are chasing ownership because you feel inferior." Painful, but liberating. Truth may say, "You need more income, not more analysis." Truth may say, "You need discipline, not another strategy." Truth may say, "You need courage, not another excuse." Truth is not always soft, but it gives direction. A lie gives comfort and takes payment later. And in money, lies collect interest. So choose the discomfort that teaches over the comfort that traps. Now let's finish by rewriting the old questions. Do not ask, "Is renting throwing money away?" Ask, "Am I using renting to build flexibility, or am I using it to avoid discipline?" Do not ask, "Is buying always better?" Ask, "Does buying this specific home under these terms make my whole life stronger?" Do not ask, "Will this property go up?" Ask, "If it does not go up quickly, does this still serve my life?" Do not ask, "Can I afford the payment?" Ask, "Can I sustain the payment and still build a resilient life?" Do not ask, "Should I invest instead?" Ask, "Can I invest consistently, tolerate volatility, and avoid touching the money at the wrong time?" Do not ask, "What will people think?" Ask, "Who will pay if I choose wrong?" Do not ask, "Am I late?" Ask, "What is the strongest next move from where I actually stand?" That last question is the one. What is the strongest next move from where I actually stand? Not from where you wish you were. Not from where your friends seem to be. Not from where your parents were at your age. Not from where an influencer says you should be. From where you actually stand. That question is honest. And honesty is where strategy begins. Maybe your strongest next move is not buying. Maybe it is tracking your money. Maybe it is building 3 months of reserves. Maybe it is paying down bad debt. Maybe it is investing a small amount automatically. Maybe it is increasing your income. Maybe it is learning how mortgages actually work. Maybe it is reducing lifestyle inflation. Maybe it is buying a modest home instead of the impressive one. Maybe it is selling something that no longer fits. Maybe it is staying flexible for 1 more year, but with discipline this time. Maybe it is finally acting because you have been hiding behind analysis. The strongest next move is not always dramatic. Often it is quiet, but quiet moves repeated long enough change lives. That is what most people underestimate. They want one grand decision, one home, one investment, one breakthrough, one perfect timing. But a strong financial life is usually built from repeated intelligent moves, not perfect moves, intelligent moves. A little more margin, a little less ego, a little more clarity, a little less panic, a little more structure, a little less performance, a little more patience, a little less drift. Over time, those small differences become enormous. And then one day, you are not simply chasing security. You have built it, not as a single object, as a system. That is the goal. A system that can include a home, a system that can include investments, a system that can include cash, a system that can include mobility, a system that can include roots, a system that can adapt, a system that is yours. Because the final truth is this: you do not need your financial life to look like someone else's in order for it to be serious. You need it to be coherent. Coherent with your values, your income, your risks, your goals, your stage, your emotional reality, your future. Coherence is stronger than imitation. And maybe that is the real definition of financial adulthood. Not owning a home, not having a portfolio, not rejecting debt, not worshiping liquidity, not following one rule forever. Financial adulthood is the ability to make coherent decisions under pressure. Pressure from markets, pressure from family, pressure from fear, pressure from time, pressure from ego, pressure from comparison. If you can remain coherent under pressure, you are already ahead of many people who look successful from the outside. Because success without coherence is fragile. It may shine, but it shakes. Coherence may not shine immediately, but it holds. And holding matters, especially when the world changes. So if you buy coherently. If you rent coherently. If you invest coherently. If you wait coherently. If you change direction coherently. Do not perform financial adulthood. Build it quietly if necessary, slowly if necessary, differently if necessary. But build it in a way your real life can carry. Because a home should not be a costume. A portfolio should not be a personality. Renting should not be an excuse. Debt should not be a sedative. Cash should not be fear disguised as safety. And wealth should not be a prison with better furniture. Wealth should expand your ability to live, to choose, to recover, to help, to rest, to build, to stay when staying is right, to leave when leaving is necessary. That is wealth worth building. And if a home is part of that, good. If not yet, also good. If never, maybe good too. The question is not whether your life matches the old picture of success. The question is whether your decisions are making you more capable, more resilient, and more honest. Because the old picture is not enough anymore. Maybe it never was. Maybe people simply did not say it out loud. A house can be a dream, but it can also be a distraction. A rental can be a bridge, but it can also be a loop. An investment can be freedom, but it can also be anxiety. Waiting can be wisdom, but it can also be fear. Only clarity separates them. So before you chase the key, build the mind that knows what the key is supposed to open. Before you chase the asset, build the structure that can hold it. Before you chase proof, build position. Before you chase permanence, ask what kind of freedom you are trading. And before you let anyone tell you what you should have by now, ask whether they understand the full price of the life they are recommending. Most people do not. They see the symbol. You must see the system. That is the difference. The symbol says, I own. The system asks, can I breathe? The symbol says, I arrived. The system asks, can I continue? The symbol says, look at what I bought. The system asks, what did this purchase cost my future? The symbol says, I'm safe. The system asks, safe under which conditions? The symbol says, I am not behind anymore. The system asks, did I move forward or did I simply buy relief? The system asks better questions, and better questions build better lives. So keep the question that matters most. What decision gives me more real control over my future? Not more applause, not more appearance, not more comfort for 1 week. Real control. Sometimes that control will come through ownership. Sometimes through liquidity. Sometimes through investing. Sometimes through waiting. Sometimes through saying no. Sometimes through choosing less than you can technically afford. Sometimes through finally acting after years of fear. But when the decision comes from clarity, it feels different. Not always easy, but cleaner, less desperate, less performative, less borrowed. More yours, and that is the place you want to reach, not the place where everyone agrees with you. The place where your decision is yours, your structure is strong, and your future self is not quietly paying for a moment of emotional relief. Because in the end, the real goal was never just to own a home. The real goal was to own your direction, and that is much harder, but much more valuable. So if this conversation made you uncomfortable, good. Comfort was never the point. The point was to take a decision that culture turned into a slogan and return it to where it belongs, inside your own judgment, inside your own numbers, inside your own future, inside your own courage. Because once you stop living from borrowed scripts, you start making decisions that can actually carry your life. And that may be the first real home you ever build. Not the one with walls, the one inside your judgment, the place from which you can finally say, I am not choosing this to prove something. I am choosing this because it fits the life I am building. That is the kind of decision worth respecting, even if no one claps.